As a trader, you probably were wondering, like, how important is it to really study the market? How important is it to really analyze, backtest the market, look at charts, and just try to figure out what exactly is the market doing? What did it do in the past? And what is it going to do in the future? And why is this so important is that you do not want to invest your hard-earned money just trialing and testing the market. So there's different ways you could do it. One way is paper trade, where you could put in a live trade, but in a fictitious account. What I mean by that is a lot of the brokers would have a paper trading account where you could put in 50,000, 10,000, whatever you would plan on investing in your actual trading account, live trading account. You can paper trade with that without bearing the losses that would follow through or the profits that would come through with it as well. And a lot of people hate this because why would I want to just play around waiting and like trying to test something out? I just want to like get into the market and like, you know, make money out of it. And that's me too. Like I would prefer like actually putting money in and trading and like riding the waves as they go. However, saying that, there is also a possibility that you could lose money by not really testing and just riding waves, and like if there's a wave that comes down and crashes you, it can crash your account too. So the smart traders, and maybe this is your first time getting into trading, or this is your 10th time and you've kind of like, you know, burnt yourself a few times just kind of trying to figure things out, trying to figure out what's the best way to trade. And that's where people would start finding this term called backtesting. So backtesting is used for going back in time and trying to predict or trying to just analyze how is the market flowing, how did it flow back 10 years ago, 20 years ago, and just use that as a baseline to help you navigate the market in the future. So, you know, markets does have a tendency to repeat itself. So for example, the recession that we're going through right now, or almost the inflation that will lead to a recession, is not the first time we've ever had inflation. This is not the first time we've ever had a recession. So this is where the market repeats itself. The market shows patterns on how and where it would move in the future. So there's different ways you could backtest. You could use an algorithm, or you could just put in a few set rules into your backtesting software, and that's one way you could do it. Now, an example of that would be, I would like to buy when X and Y conditions met. So for example, if the RSI is at a certain value, if the MACD is at a certain value, if the moving average is at a certain value, I would like to buy, and I would like to sell when it actually ends at that certain point, whatever is your trading strategy. So that's one way you could do that. The way that I like doing it is by actually analyzing and studying the candlesticks. In other words, it's called price action. And the reason why I feel, and it's just me kind of like studying and my revelations from the market, is that if you depend on these moving indicators, and like I do look at moving indicators too, so I'm not saying you know, they're not good or like, you know, anything about them, but indicators do have a lag to it, and what that would then result in is that you would be buying when the trend's ending, and like you would be coming in when the trend's like, you know, not even there. So they do help confirm your strategy, and like it gives you another point of confirmation. However, I do feel and believe that it's important to keep indicators as a method of confirmation rather than an entry point or an exit point. Now there's different indicators, there's so many, a plethora of indicators that you would find on a trading platform like trading analytics platforms such as TradingView, or even your trading brokerage firm would have like so many indicators. So there's so many around there. You could always use that as a secondary bias to predict or help you guide you in whether it's a good time to buy. Common ones would be RSI, MACD. You could also go into the more complex ones such as Williams, percent R, you could go to the stochastic. So there's so many of them, and these are just a few common popular ones I'm talking about. So back to my strategy. So what I normally do is I like looking at price action, because in my personal opinion, price action is the best or the most forward indicator that you have. If a candle is formed, it'll tell you what is going to happen next with it. You could use different chart patterns to tell you, okay, this is what the market's done, this is what it would possibly do. It's never a guarantee, but this is what the probability of it happening is. So you kind of have an idea of like, okay, the market's, I think, going to do this, the market may be going to go there, and that helps you in navigating, that helps you in deciding what's the, the best foot forward in terms of like analyzing your market. So a lot of people would depend on like, backtesting certain, using certain criteria, so like rules that I talked about, and certain people would like looking at price action. So today, as part of this video, we will analyze and go through charts. This is from an historic perspective, so we'll go back to I think this is around 1998 all the way to 2022. We'll look at the weekly time frame, and there's no hard rule on why it should be just weekly and daily. We kind of like try to hover between the two, daily and weekly, and you could go down to like the hourly level as well. If that's your trading strategy, is to look at the hourly charts or the daily charts or the 4-hour charts or the weekly charts. You could go down to that level and just kind of back test, and like, I'll show you what that back testing is very soon, but just to give you context on what we're doing. So just heads up, this would be a long video because we're covering from like, 2-3 decades worth of content of charts. And the reason why I'm going to weekly is the weekly has, or is very highly respected by the institutions, and this is where the big money comes in, because they've got so much money to trade, they can't be intraday trading. So they don't really spend time putting in, because they would actually like cause the market to just like turn in on its dime. So they invest on weekly charts, or they will trade on weekly charts, even though they've got algorithms. Some arbitrage traders, hedge funds, will look into short-term like scalping or like short-term moves, but the bigger firms would prefer swing trading or prefer trading on longer time frames. So that's where weekly comes in. It's very highly respected, but it's also hard to time your entry on a weekly time frame, and that's where we would go into a daily or a 4-hour, or if you're just like so anxious, can't wait so long, go into the hourly time frame to give you a good entry point. Having said that, you will still be reliant or just keeping a close eye on the weekly time frame, because that's what's going to tell you where is the market heading into, what is the direction of the market, where is the market portraying itself into the next week or the weeks to come. So always keep an eye on the weekly, maybe monthly too. And monthly also does play a big role in giving direction to the market. And for timing, you can then predict, you can then select, you want the daily, you want the hourly, or you want to go down more into like the smaller time frames as well. But always have an eye on the weekly. So I hope that was a good introduction. My trading strategy is trend following, not trend predicting. So you'll see me talk about following the trend, never predicting or never kind of like stepping in front of it. What we're going to do is we're going to let the market play, and I'm just going to pause in between and talk about it and tell you, okay, so this is the market, this is what it's going to do, this is what it's done, this is where you could have possibly entered in if you were interested in, this is where you would exit in as well. Now, we would be using some kind of indicators. As I said, like we would not just like completely isolate ourselves from indicators, because indicators do help us to give us good guide rails into where the market should be heading, what should be a good entry point, what's the direction it will take. So what we would be using is a few moving averages, especially to time my entries on, like, the 50 period moving average, the 10 period moving average, the 20 period, and I'll kind of talk about it when I start showing you the charts. So moving averages is one that we use, volume is another that we'd use, and if required, I would say keep RSI on. So this is just me teaching you how you could study the market, but you would have to do your own homework. But if you're, like, not so aware of what to do and how to track it, you could just, like, go through my videos and just kind of, like, see, okay, where or what would the decision making points while you navigate your personal trading journey as well. So I hope that was helpful. This is just a prefix. So this is a definitely, like, heads up a long video, as we would then journey through almost 2-3 decades worth of trading time. And why this is so important is that it'll help you, help you navigate, or help you fast forward your trading study or your trading journey. So if this would take you, say, you would spend 5 years or 10 years to really go through that same time period and understand the market, this is a tool where you could step back in time and then, like, use that as a platform to take you to the next level, if that makes sense. So with that, I'm going to get into the weeds. Let's get into the charts, and let's talk about a little bit about our setup, and then let's dive into the actual trading. So let's get started. So here I am on the S&P futures, and I've gone back to the most that my trading platform could take me to, and this is TradingView for example. And I've gone back to September of 1997, so it's a long period of time. So we'll go from 97 to 2022. That's the journey that we are heading into. So S&P futures, the reason why I chose futures is futures helps predict the market. They are open for 23 hours of the day out of 24. They just close it down on the weekends for a small period of time. But it also is a market that's open even during after the trading hours. So it doesn't really show up on the weekly chart. So that's something you won't see. And also after this particular video, where we go through S&P 500 for, like, until 2022, we will then look into other indexes as well, other stocks as well. We'll do Apple, we'll do Facebook, and just kind of get different perspectives. And a lot of the times, like, me personally included, it's too boring to actually go through these different chart patterns and study them on your own. So by kind of collectively doing it together, you don't feel like you're actually just doing homework on the side and, like, boring stuff. Like, I would like to just get into the market and do it. So you could just, like, play it in the background, just the commentary on, like, how it's moving, what the trends are, what to keep in mind on the market. So it'll give you, like, you could just, like, do it in the background while you are trying to get a perception of, like, how the market is. Now, the weekly chart's the most stable one compared to the daily, compared to the 4-hour, compared to the hourly, and then the 15, the 1 minute would be, like, all over the place. So in perspective, like, the weekly is more stable. And what that means is that, there's lesser chances, if you get in at the right spot, there's lesser chances that you could be stopped out, or you would be just kind of, like, not knowing where the market's heading. Now, it's important, having said that, to get in at the right time, get out at the right time. So that's where we will just kind of step into the daily time frame just to get a better perspective as well. So we'll hover between the daily, the hourly, not the 4-hourly, because I don't think I have enough data as we're going back to 97. But we will, like, as we move ahead in time, look at these, like, shorter time frames too, to help you time your entry into the market. So that's the plan. I'll just give you a little basics too of, like, what TradingView is, what are we using it for. I'm, again, not sponsored in any ways by TradingView to, like, show you this video. It's just me trying to educate you into the market. Now, this is something that you use for your own education purposes. And while I talk and while I explain the market to you, you might think about better ways that you could do it. You'll be like, oh, Sheldon, I should have tried this out. Or why not, like, buy it at this point? Why not sell it at this point? So, it'll get your minds thinking. And not everything that I say is what I would like you to do. Like, you have the free will to come up with your own strategy. There's a saying that goes by, there's different ways you could skin the cat. And not saying that, you should skin your cat, and like me saying that with my cat just sitting on the side of me. And I do apologize for that. But it's just like, there's different ways you could trade the market. There's not one straight way that is like universally applied. But having said that, as you look at these different trading chart patterns, you will see that there is a theme here. And this is going back to 1997. I've actually studied a few charts way back in 1960s and 50s, and they also still follow these same trading patterns that you could call it, where they respect certain things, they don't respect certain things. So something to keep in mind here as we kind of educate ourselves about these trends. Now I do have the volume in front of me, and like the volume is important. And the reason why the volume is important is that the volume tells you what is the next candle, or what the candle is actually meaning in terms of the strength in the market for that particular candle. So it'll make more sense when we get into the weeds of it, but just something to keep in mind. Volume's there. Now the moving average lines. Now you will notice that I do have a lot of these moving average lines in front of me. So for example, the yellow line is the 20-period moving average line. So what I've done is that I've thickened that line up, and I've thickened it because that is an important line where the market respects it, especially on the 20-period moving average line on the weekly charts. So that's something to keep in mind and pay attention to as we talk about these markets. Now, there are a few more moving average lines that I have on my screen. So this next one that you see here, which is just like faint, is the 5-period moving average, and I believe it's the 5. I'm just gonna drag this down a little so that I could see it. So I've got the 2-period, the 5-period, and as we go through it, you'll see there's like the 350, the 400, 450, 200. There's also the 10, 20, 50, 100, 150, 200, 250, 300. And you'll be like, why, Sheldon, do you have so many of these moving averages on your trading platform? And there is no hard and fast rule. You should not have so many. You could just go around and be okay with having a 20, a 50, a 10, and the 200. The 200 is the most important. So if you were to prioritize which ones is the most respected, 200 is number 1. The 50 is the second, the 20 is the third, and the rest is just like add-ons. Now again, these are just guide rails into helping you time the market, get in, kind of know where exactly the market's heading into, when should you stay away from the market, and when to get into the market. Now, our trading strategy, again, this is just one way that you could trade the market. The trading strategy that we would use in this particular case is buying closer to the moving average lines. Now, which moving average lines over which moving average lines? So the 20-period moving average line or the 50-period moving average line is the safest in an uptrend, and also in the downtrend too. I'll show you more rather than just talk about it. But the 20, 50 is the important. So we buy closer to the 20 and 50. Some people could call it the mean reversion, where the market just what's mean reversion is the market moves up away from the mean and then comes back to it. So you buy closer to the mean, and that's a strategy. People trade with it as well, and does make them good money. Or a trend trading strategy where you buy the next candle that goes up, or a breakout strategy. So for example, this is an example of a breakout where this was the line, the market crossed it, it went up, that's a breakout. So there's different ways you could trade. You could either do a breakout, or you could do just a regular trend trading where you could buy closer to the moving average line and let that take you away. So different ways to skin the cat. As I said, you find your way that pleases you, find the way that is your trading style. Different time frames too. For now, we are just looking at the weekly, just so that it's not like a day's worth of video content, but we just skim it down into a few hours. So with that, let's get started. Let's get into the weeds. We've talked a lot about, the basics, the foundation of what we need to get into. And now let's see how we could apply this into our trading strategy and study this so that we come out of this better traders. So the goal at the end of this is that when I put my real hard-earned money into trading, I should be able to time myself to get in at the right time, get out at the right time, because I know better. I have studied the markets. I've looked back at trends. And if the market respects those trends, those markets respect the way it has moved in the past, I should be able to come out profitable. And that's the goal. And that's why we're spending so much time understanding and doing all the groundwork, the homework before the market or after the market closes. Okay, so I hope that context clears you up. And let's get into moving the market ahead. So I've just gone into replay mode. I've kept it at May of 98 right now. It's on the weekly time frame, so you'll see the market. Each candle is a week, so you'll see it kind of oscillate and move around a little bit before it decides where it closes for the week. Some basics for you, if you don't know what a candlestick is or how does it actually form, wherever the candlestick starts, this is the open for the day. If it goes up and closes right at the top, that's the close for the day, and that's where a green candles form. If the candle opens here and closes down lower than where it opened, that's where it will form a green candle. The wicks that you could call it, so you can see on this particular candle, there is I could actually use a different pen just so that I don't just dilute what I'm trying to show you. Let me just find the pen and come. Okay, I'm back. So what I'm trying to show you here is that this particular candle, you can see these wicks here. So it's actually between this and this line. So what that is the reason why I brought that up is that the candle between these is the travel that it actually performed for the entire week. So it's rare that a candle opens up here and closes up here right at the top. But that is actually a good sign. If the candle does that, it is actually a good sign of strong positive momentum. That means that the market's going to move up more in that direction. That's a positive sign. However, the market's never just open and close right at the top. And that's, if it does so, it's the most easiest trades you can ever do because you're just buying and selling right at the top. The trouble or the tricky part is when the markets actually will provide you some wicks. So like this one, this was a wick on the top, this was a small wick on the bottom. Now, the important thing to keep in mind is if the market loses momentum, you'll see a little bigger wicks at the top. So I'm trying to just get rid of a few things here and show you. So you can see these wicks at the top here. That's a sign that the market's losing momentum, and that's why it's just going to the top, plateauing, going to the top, plateauing. And at the bottom too, like the market's trying to head lower, and then it kind of like bounces back up. And that's a sign that, okay, the market's still like trying to oscillate and decide where it's going to. So that's something to keep in mind, because whatever time frame you trade, if the market just goes up and just kind of corrects itself and comes back to the norm, you will lose money. But I'll show you how to navigate that. So stay with me, hang on there. This is just the start of an amazing study session. So keep that in mind. And I hope this is helpful to you. I'm not just doing it to just kind of like just throw it out on the internet so that like no one pays attention. I hope this is helpful. Like study it, and in the long term it'll benefit you too. So like you could study in your own time, try to gather some insights out of it, see what makes sense to you, see how you could apply it to your trading, and I hope it makes you a better trader and a more profitable trader as well. So having said all of that, let's move ahead. So I'm going to move it slowly at the start because I want you to pay attention to what exactly is happening here in the market. Okay, so what I'm doing right now is I'm kind of like, let's zoom out a little bit, not too much so that you just lose perspective. And you can see the market's forming a new candle, and it's moving really slow, but it's, you know, taking its time to decide on what's there. So we're going to just let it be. Now I'm going to pause here. And this is just the first oscillation, or the first kind of like, you know, move or swing or the trend formed in the market. So I'm just going to pause here and ask you, if you were at this stage, and this is how you should be trading in your own personal time as well, is that if you were at this stage on the weekly chart, and I can move to the daily chart as well. Like the daily is messy with what I just did, and I'll try not to just scribble on top of it. But if you're on the daily chart, like, you know, oh my gosh, I can't even tell what's happening here. But okay, let's go back to the weekly. So if you were on the weekly chart, and this was a time period of like, you know, of you deciding on, is it a good time to get in or get out? What would you do? Would you step into the market here? You know, so ideally, like buying at this level would have been perfect. You know, just say the market hovered here, it kind of like, you know, oscillated here and started to move up. I could have possibly gone in here with a stop loss below the yellow period moving average line, the 20 period moving average line. Another thing to keep in mind, and I'll show you this in an actual chart as soon as we go away from the scribble lines, because it's going to, like, you know, you'll be like, what did you just tell me? But if I'm looking at the weekly chart and it's touching the 20 period moving average line, if I was to look at the daily chart, and I'm just going to show you what that means, this is the 50 period moving average line, and the market actually touched the 50 period moving average line. If I was to look at the 4-hour chart, which I can't do right now, but if I was to, the market would have touched the 200 period moving average line. You know what I meant by all of that? The market, basically, because you're zooming out in time on a higher time frame, if the market respects the 20 period moving average line on this particular chart, it will respect the 50 period moving average line on the smaller time frame. It will respect the 200 period moving average line on the smaller time frame, and that's how it goes. Now, that's the reason why I have, you know, all these moving averages all the way to 400, 450, because depending on the time frame you're looking at, it may respect a line on a different time frame. But for you, depending on the picture you're looking at, you know, the 20 period is good enough for you, because that's what the market will respect the most if you are trading on the weekly time frame. Make sense? If it doesn't, I'll actually show you more practical examples of that. This is just a start. So, you know, if it's too overwhelming, you have an entire trading study course to get to. Okay, so back to where we were. As I said, you could actually purchase, like, get into the trade around this period of time. It would be the safest. Now, looking at this, you know, volume's good. The price action's good. It kind of corrected itself, like touched itself here, touches the 20 period moving average here, and it's kind of heading up into the positive territory. So it seems to be like checking all the boxes. I can or cannot tell, like, okay, is it going to respect it? Is it going to, like, keep going in that direction? But let's see what's in store for the market. So I'm going to let the market go now a little more faster. Okay, I'm just going to go to so that we get some momentum now. That we've got the concepts, you've got the basics there, and I will pause as soon as I see an opportunity that I need to, like, you know, talk to you about. So I see now the market's kind of just kind of hovering around this particular area. I think it's trying to form kind of like a zone where it's consolidating. towards the 20 period moving average line. As I see here, it's still like hovering on it, and this is weekly, so each week is one candle. Now the market's taking off. So as I said, like if you had to buy it around the 20 period moving average line, as I talked about, you could have ended up in a good, decent sized profit. Now, again, I'm just going to pause here. The reason being that the markets, when they touch the next, like the top of the previous high, the markets do tend to oscillate on it. So what I mean by that is the markets would possibly tend to like either move up and then come back down and touch the previous high, or the resistance that was formed there at the previous high, and that becomes a support, or the market may just go through it. Now, when the market just breaks through it, there's a lot of breakout strategy traders that will come in and be like, okay, it's my turn to get into the market. So you might see that spike up too. So a good way to track that is to check the volume and see what the volume is doing there as well. So I'm just going to go out of this. I'm going to go back to my cursor because I like that better. So I'm going, and I've chosen the arrows, because the arrow is a better way to like just show you what I'm talking about. Okay, so I hope you can see the arrow. If you cannot, I apologize. I'll try to find something better than it. Okay, let's get back to it. So this is the it's heading positive. It's going to break out. Let's see what it does next. So I'm going to let it flow. I'm let it play through. And yeah, so the market's thinking, market's trying to decide what's the best path forward. I'm just going to move it a little more faster so that we get some more momentum now. Now that we got the concepts, you got what we're going to do, and now let's move ahead. So you can see the market broke out of it. It's heading higher. Now, my way of trading this particular trend would be I would keep an eye on when the market shows weakness, because what's going to happen here is the market will go to the top. It could go more on the top. It could just kind of stagnate and say, okay, I've done enough of running today. So, okay, let's backtrack. Let me just kind of give you an important concept, because this is good theory for you to understand the markets. So the market has different stages of growth. It has a stage of like just consolidation, where it's just flat and just choppy. Now, these are the stages you should completely avoid, because however good of a trader you are, you could possibly, and I say could, I didn't say you will definitely do it, you could either get stopped out by putting a stop losses not in the right places. You could also possibly have an opportunity of like stepping in and the market just kind of comes down. So there's a lot of like range bound trading is like something that we advise, or people would say don't ever do that, because there's less chances of a profit, and like the risk reward's not the best as well. So the way you would identify it is that if you see the moving average lines kind of like pass through the candles, that's a bad sign. You should not do it. If the moving average lines are above it, it's a good sign. So like, as you see here, it's above the moving average, and that's a good sign. So you can see it's gone above. Above the 20, that's a good sign. If it's going through the 20, through the 50, the candles are going through it, it's not good. You don't see these candles here because it's a 20 period, so it needs 20 candles to actually start averaging itself out. And that's why you don't see it. So you won't see the 50 yet, or the 200, but give it some time and they'll all kind of like form its way up. So hope that made sense. Another thing is, so as I said, this was the a stage in the market where it's like consolidation, doesn't know the direction. It breaks out of it, you step into the market, it kind of breathes here, it has a second run up, and I would say try not to get into this a particular stock if it's run up more than 2 times, because it'll then kind of like correct itself and go down. So it could even happen now, where the market could just like correct itself and come back to the 20-period moving average line. So as I said before, like keep an eye on what happens here. Does the market correct itself and come back here? And the way you would identify it is by the candlesticks. So that's the entire point of price action trading, looking at candles, because that's the best indicator that would tell you where the market's heading. Okay, so enough of theory. Now let's look into some action of the market. So as I said, like the market just kind of like consolidated itself. It went up a lot and now it's trying to come back. Where would it come back? It would at least touch the 20-period moving average line, and then decide, is it the end of the move, or it may go down. So it broke through and went down to the, like, it may touch the 50. Now we don't see the 50 year, and that's just because we haven't finished 50 candles of data yet because of the time frame that I have on my my trading view platform. I'm just going to pause here. So a good time to exit this trade would be at the top. Now, the reason why I have these small, like finicky, like, moving averages in there, and this is like the 2-period, this blue line is the 5-period, is that you could even use that as your selling point. So, you would buy somewhere here, put a stop loss below it, but the stop loss would be a trailing stop loss. That's what I prefer. It does give you a lot of room to let the stock move, but if it's in a profit, you don't want to lose it. And trust me, it's happened to me so many times, is I've stepped into the trade and lost all of the money, all the gains that I've got, because I was greedy. I felt the market would move higher, and it never ever works, right? Always in your direction. So trust me, trading stop losses will save you a lot of money, a lot of pain, a lot of heartache. You can always go into the market, but don't give your hard-earned trading insights away or your money away by just letting the market take it all back. So now again, trading stop loss, like what is your sweet spot? Some people would say 10% trading stop loss is good. Some people would say 5% trading stop loss is good. Some people would be ready to just sacrifice 1%. Now, if you go and sacrifice 1 or 2% or 5%, you do have a tendency to get stopped out in case of the market. You can see these big wicks here on the top and the bottom. They can kill you in terms of like kill your trade. So even though you are in a decent profit, it may just like touch it and just go back up again. So something to keep in mind. I did actually do a study of like what's the best trailing stop loss, sweet spot. And the professional traders do prefer anywhere between 10 to 15%. Now that could be a lot depending on your trading size, and like, if you're trading like millions of dollars, that could be a big amount. So I wouldn't say put in like 10 to 15%, but anywhere from between 5% to 15% is where you need to find your sweet spot. So there were studies done where people found or identified 20% would have the most amounts of profit over a long period of time if you're a long-term trader. But for some people, 20% per trade, not for your entire portfolio, but 20% is a lot. So find your sweet spot between 5 to 10 or 5 to 15 is where I would consider, you finding a sweet spot. I know a few shorter-term traders that like the 5% mark. Some people would attach to 7%, some 10, some 15, but don't go too crazy about that unless you're like Warren Buffett keeping it for ages. In that sense, it makes sense to keep it. Okay, back to where we were. As you saw, the market just kind of crumbled down a little bit. I'm just going to let it play a little faster now, since given the fact that we want to kind of get some momentum, I need to also see the other moving average line, because otherwise I would have seen, oh, it just came by the 50 period moving average line. So the market just touched it, bounced back, could not respect it, and it's gone down further. So it'll go back to its mean. This is the mean that I'm kind of like thinking of it probably reversing to. I think it did do that on a daily time frame basis. And this is the 50 period moving average line. It's just kind of piercing it to here. So if you were a trader and you're kind of trying to find like the best value time frame to buy, as I said, buying in near the 20 period moving average line and the 50 period moving average line is a good way or a good time frame to get in. And now comes to, so it actually like pierced to the top, and now it's going down below. So that's where it is right now. And you kind of would be under the impression of like, okay, like, should I be buying your? I would say yes, you could possibly think about buying your. It just kind of tapped down to the bottom. Also, this is around 1998. I'm trying to think, did we have anything bad in 1998? I don't think so. 2000 was like, the dot-com bubble crash. So, like, again, I'm not trying to go back on history. I'm not back to the future to kind of like tell you what's going to happen in, but so like to this, like, I would say, yeah, you could possibly buy it at this. It's a good area of value. Put a stop loss, put the stop loss somewhere down here, and see if you could kind of get some, I guess, momentum to the upside. It could work in your direction. Or you can also be safer and say, okay, no, I don't want to get it here. Let it actually show me come back to the positive territory. And a lot of the traders would not buy on the first bounce. They would wait for the second bounce before getting it and then close it down here. So it's a trend and it's moving up. It's a hit and a miss kind of rule. Like sometimes it'll just have one direction, but you should still wait for confirmations of trend. This is an early B we're trying to get in, but you should actually technically wait until it comes out of it and then step in. So again, I'm going to let it move ahead. In this way, we can see where the market's heading into. So if I had to buy it here and was predicting it's going to go ahead, it would have been a loss, because the market, what it did was it used the 20 period moving average line as the stop. So a better way to actually get into was to short it, but to short it around the 20 period moving average line here. So as you said, like, you buy if the candles are on top of the 20 period moving average line, you sell or short sell close to the 20 period moving average line, but when it's below it. So this is a period where you would sell, and you could get this down here. So 2 weeks of gains approximately, and the third candle where it actually kind of moves back up, you can sell it. So 2 weeks is a decent time frame to hold a particular, in ES it could be a futures contract. And I'll also talk about scaling as well, as time goes by, but just to give you a little perspective, so scaling can also be applied. So it's moving up. Again, I'm just going to let it play and see what it's trying to do. So the market's just kind of establishing itself over the 20 period moving average line. So another thing that it did here, and it's not a perfect example, is it did go, and this happens into a lot of stocks. The market will come down, kind of make a low. It will touch the 20 period moving average line. So it kind of took a base around the 50 period moving average line, touched it on a daily time frame, not an intraday, on a daily time frame, and then went back down, formed a double bottom. So that was what I was trying to tell you, is that it formed a double bottom, and now it's gone up again. So wise traders may think, oh, it's a double bottom, and buy closer here. So some people do that. It's like how confident you are. Now this is not a perfect double bottom by any chance, and you'll see different examples as we go by. these are not perfect double bottoms. So market's gone up, broken through the 20 period moving average line. So if it breaks through this, I would say this is a good time to get in, because what the market would do next is, since there is no support resistance, it could possibly head towards the 1193 level. So I'm going to just change this to the cross. Yeah, it's going to head towards the 1194 level, most likely. Again, I'm not predicting, it's a trend follow, but I would like, get in around your and see, okay, where are you taking me? Like, show me the road. Sometimes if it does like a big candle up, it might just kind of like, try to find another support. But let's see. Oh yeah, it did. So it actually, let me see, it closed that particular week and see. So it did form like a fake double bottom, but the traders would probably be like, oh, it is a double bottom, I'm gonna go into it. And then it formed a double top. Now, what does that mean here? So people that would see a double top, so tops means like Twin Peaks, it's gone one top, second top, and you could just go through, just Google and see like what exactly is a double top if you ever want to. So what is happening here is that there could be a possibility that the market could just kind of like breathe a little, come down, because it's overextended. As you remember, the markets never just like go to the moon. The markets will, let me just go back a little, go up, come down, breathe a little, again, take another like, spring up, come down again. This was a bigger drop down, and then again, it could do something. So it could possibly, since it's a double top, again, we don't know what the market's going to do, but most likely it may just kind of like breathe a little more towards the downside, and then go up a little. So yeah, so it kind of like went up, consolidated, came down. And another thing, so you will also notice as you study trading more, and this is just me giving you my insights, some cheat sheets into the market. So you can notice here the market actually went down, and this is my observation. I could be wrong, but this is my observation. The market went down to like 1148, came back up, and the second candle, it actually moved to the top here, and again went down, and then again went down. So what the market's doing is that it actually like kind of took a plunge before, and if it did not actually complete its trail down, it kind of like reversed up, it will continue following down in the weeks to come. So for example, it will not apply if it's at the bottom. So if it's at the bottom, the market's already touched whatever it has to touch. So maybe it's the lower low that it's supposed to do there, but it won't come back here. However, if it's like on a trend down, so you can see this, it went from your 1095 to 1058, and then went back up, closed this candle here, came down here, moved like, so this was kind of like the oscillation in between where I wasn't just sure what to do, but that's what it does. So my observation has been that the market will tend to always follow through, especially on a new trend. So again, let's continue. So yeah, the market here is okay. So the market here is touch this again. Now, why would the market just kind of like touch this intraday? And the reason being also could be that it is trying to respect some of the smaller time frames, the moving averages there. And one more thing to kind of let you know about is that if the market is in a strong trend, it will respect. So I'm just moved to the daily chart, and I'm trying to prove a point to you. If the market's in a strong trend, it will not touch the 20 period. If it's usually touches the 20 period, it won't touch that. It would go one time frame above, because it's got so much of momentum that as soon as it touches something that's enough of a support, it'll just like bounce out of it. An example of that would be the market went down for 4 days, and this is the daily time frame. Touch the so this is the 10 period moving average line. That's a green line there. Touch the 10 period and bounced up again. Touch now this is where the market's like fatigued, comes to the 20 period moving average line and then comes back up again. And this was the 20 period line again and then bounced back up again. So depending on what the market's I guess appetite is for momentum, it will like show you different I guess ways in how it would react to the market. So again, back to where we were, the market is now heading higher. It's made a new high. You know, we are all like, oh my gosh, this is like the market's doing amazing. And let's see what it's going to do next. So it's gone higher. It's making a new high. Now, another thing to keep an eye on is for doji candles. So doji candles is, I should have waited for it to actually come through and then talk to you about it. A doji candle is basically something similar to a wick, but it's equal on the top, equal on the bottom, and it's a very thin line. So this green one here, I didn't see it actually. Yeah, this green one here is a representation of a doji candle. Now, it doesn't make sense when the market's flat and it shows you a doji. That means that there's indecision. But it's extremely important if you see a doji candle right here on the top, because that means there's indecision on a big trend and the market's going to reverse itself. So now, if you're looking at the weekly chart, in the middle of the week, it may just give you a doji and you'll be like, oh, the market's going to turn. I'm going to just like start charting the market. So avoid that. The best time now this is me kind of like throwing so many bolts into your core about like ideas. The best time, if you're trading the daily time frame, to put in a trade or to close out a trade would be close to the end of the day, because you see an entire lifespan of a candle. And that's if you're trading the daily time frame. If you're trading the weekly time frame, the best time to get into or get out would be at the end of the week. So Friday is when you would see a lot of momentum, because a lot of the traders would be stepping into the market or like, you know, kind of like getting in, because that's another important sign that the market has a lot up its sleeve. So another thing to just keep in mind, it may help you out when you're trading. I'm going to let the market move ahead a little more. And as you can see, the market's, you know, heading up. It took a break here. So now this is an important line, because this is the second time the market's touched this line. And this is the 10 period moving average line. So if you were on the daily time frame, that would mean it would be probably the 20 period moving average line. It's always like doubles approximately. That's a multiple that it goes by. So yeah, the market's been like stagnated here. So I'm just going to pause one more time, talk about this a little more. So this is a period of where the markets consolidate. So they've actually made a fake double bottom, about a double top, where, you know, they kind of like were not sure is this going to go on top or bottom, but it decided to pull through. This was a breakout. So if you're a breakout strategist, you would have come here and taken it there. Now this would be a really tough one, given the market dynamics, because it's not a trend yet to predict this would be the spot. So you could either like short the market here, expect it to like, you know, go over here and then shut it off, or you could buy it from here, which would be a very like rare thing to like consider, because like, you know, what's going to tell you the market's going to just like bounce out of this. But the more confident traders, or I guess the traders that would have like a better probability, would be through a breakout, because it broke out. There are breakouts and fake outs, where it'll break out and then it'll kind of like bounce back down again. But on the weekly time frame, and one way to prevent you kind of getting sucked into a fake out would be waiting for the week to close. So in the middle of the week,
the market may just like, like what it looks like right now is not what it will end the week with. So it's important to not just look at the day or like, how it's moving during the day, but wait for the week to end. And once it ends, that's when you will be like, okay, now I want to go in. So just keep that in mind as well. Like, hope that will be helpful, but yeah, just keep that in mind. So yeah, I'm going to let the market to ride a little more. Now it's just consolidating for a while. It's in this range bound. So what I would advise you to do is, if you are in this range, you've kind of like, capped it out over your, it touches the bottom. It's kind of like hovering. I would mostly just exit the position, because where is it going to go? It's either going to go and touch the 20-period moving average line like it did before, and then it was in consolidation. So that's something I can expect. It could either even go and touch this line, like this particular line, because on an intraday basis, or in this case, it broke up. So it's hard to really tell, like, okay, like where it's going to go in this particular zone, since it's overstretched. Now this is a resting period, and the market's done that by resting in this particular zone rather than like just kind of consolidating down. So it does indicate that it's a strong trend, because as you can see, it's this 10-period moving average line is now so important. So yeah, you could either like wait until it touches the 10-period line as a touch there and bounce back, and that's where you would have a support. You would have a trailing stop loss just below it, and yeah, you could go that way, or you could just close it. If it crosses a breakout, then you can go in. So that's two different possibilities of the trade that you could like start with. And so the market's open up a new candle. It's gone up. Did not really like do too much. I was expecting it to like really ramp up, but okay, now it is. So it touched, if you notice here, it touched the same 10-period moving average again and went up again here. And it's doing something very unusual where it's like just opening up in random spots, and the reason being that it's because of an intraday basis. So the week starts here and the week ends here, but during the week or like pre-week opening, it may do something different where like it opens on Sunday evening. So I'm guessing that's the reason why you'll see these gaps in how it's performing. So I'm going to pause here, another like important milestone. So as you can see, the average volume is pretty low around this time frame, and the average volume here in these candles is high. So what it tells you is that, say if this is an entire trend, the participants of this trend were more interested in trading around this time frame rather than at this time frame. So they kind of are given up trading. So that indicates, the lower volume indicates that either there is no interest in the market, so it'll start causing the prices to go down. And as soon as it touched the line here, and I think the big candle is also because it made an intraday or intra on a daily time frame like gap down, and that's why it caused it to kind of spike up a little. So just kind of pay attention to the volume. Important things to keep in mind. So if you're looking at volume, if you see that the volume candle, not the candle, the volume bar is huge, but so in this case it's fine. But if it's like a very tiny volume candle, but there's a huge bar, that seems that it's not right. That's probably insiders doing, or there's market manipulation happening. Now you won't see this so much in like the S&P because it's the average of 500 companies, and it's really hard for someone to do something like that. But if you're trading like small caps, mid caps, that's common where you would see these unusual weird candles coming up. So again, I'm going to continue. Let's see what is in store. So it seems to be respecting the 20-period moving average line. So if you were to put a stop loss somewhere you are now, again, like if you were too close to the line, you would have got stopped out. But so you have to keep a healthy gap there. So yeah, it touched it. So it was like a strong trend where it bounced up the like the 10-period moving average lines. Even though it had less volume here, and then it kind of like, you know, touched the 20-period and then it bounced back again. It moved high, but now it's kind of consolidating its way back to the 50, I believe. So let's see where it's headed to next. It broke to the 20-period moving average line. And yeah, it's still on the 20-period moving average line. So, and that's one of the traits of like the weekly time frame, that it keeps changing so much. But that also is something you will see on the daily time frame, or if you go to the hourly time frame, within the hour it'll change so much too. So it finally gave up, and this is where, this is 1999 of October. So this is where you would now, so this is a bull market. A typical bull market, October 98 to October 99, a bull rally. You've heard that a lot of times, I'm sure. And I think around December 2000, or like, I forget the actual time frame, but you'll see it witness a real like a bear, I guess, or the crash. So this is with the dot-com bubble, where like, you know, the market is really like moving up so much, tremendous like up moves. And so the way you identify weakness is you would see longer red bars compared to the green bars, and that's what you see here, like, you know, longer red bars. The market seems to holding, so it bounced out of this, made a new high. It could not do too much, so that says that okay, it touched it, but there was not too much of like runway to really climb up. It tried a little and it fell back down. So if this happens, this is an indication. So this is one sign, but it's still like, you know, you could have bought here and made some small profits, but this is a sign of like, okay, if you're arching like this, there's not enough strength. And it tried again, it was trying to go below, but you'd be probably tempted to like buy here, and you could still make some kind of money. Like, you know, it went all the way here. You could have like, you know, closed your position here, and before it actually touched this again. Not too much of money, but something. So, okay, like, let's see where it's going down. It's touched the 50 period. Now it's trying to see, okay, can I bounce out of the 50? I see the red candles being stronger and longer now compared to the green one. So, so now it's trying to take support on the 50, and yes, it did bounce up that 1 week. It touched the line, and now it's gone above the line. And yeah, let's see if it tries to make a new high. It did have a high. Now this is going to form a double top. So let's see if it has enough of strength to break through the double top. So you can see a doji form there, which says it's a sign of uncertainty, but it still prevailed through it. It like moved further up from there, and now there's a big long red candle, and then it recovered. So again, let me pause here. It's an important lesson. So if it makes a big drop like that, there could be a lot of different reasons. So I think this is the Y2K drop. So this was the Y2K drop, because this is the 3rd of Jan 2000, and that was a big thing back then. I don't know what is the age demographic of this channel, but if you were around in the Y2K, there was a lot of rumors that, okay, computers may not be functional anymore. Like there's a lot of speculation on like how would everything work, and like the clocks would reset, and especially the Windows computers, there was a lot of issues about it. So I think that's what caused like the big drop down, and then it kind of recovered from there. Now, there is a tendency, as I said before, if the markets do that on a regular, like on a normal day, it just kind of like, you know, shrinks down so much, there would be a tendency that like it'll kind of like try to fill itself out on the lower side. I've seen and noticed that happen a few times, but I don't know if this is something, because this is just the Y2K scare. Today or this particular instance would be different. So let's see what happens next. So it did turn out true. So the market did actually drop down. Now a lot of people, you know, saw this pierce through and they were like, oh, it's a time to buy. The market's just like touched it. No, the markets don't really do that. Like in the middle of a trend, it doesn't just like pierce through like your skin and then come back and like be, oh, it's all okay now. Like, you know, it's fine. No, it doesn't do that. So yeah, the market's gone down, touched the 20-period moving average line. Okay, what's next? It's going lower. I'm just going to take the cursor out. It's moving towards the 50-period again without a big rally. Well, it had a rally, but I wouldn't really consider it like big enough. It's pretty small in terms of like what it actually just did. So yeah, so it actually bounced back up again. I'm just going to let it play out. Oh, and now it did a huge jump up from the 50-period moving average line. So that's really amazing on like how it could actually just like rally up from there. So it went up 4 weeks in a row. So again, a few little lessons for you. I hope you're taking notes, well, you know, as I'm talking about this, because what I'm trying to do right now is share lessons that I've learned studying other charts, you know. And this is not my first like, oh, this is let's like create a YouTube video for like, you know, I've actually studied them in the past too. So another lesson is that markets rarely will move up like on a candlestick pattern, like move up 7 days in a row. Like, so I'd say 4 or 5 days is the most, 7 is like the top. If the market moves up more than 7 days, there's like, you know, a big kind of downfall also coming with it. So the markets just don't go on top, it'll breathe, right? So yeah, 4, 5, 7 days is the average that you would see, or the most that you would see that the markets go up. So that's where I was pointing out. So 1, 2 weeks, this was actually a really tough week if you were trading. 3, 4, 1, 2, 3, 4, 5, and then there was a low week. 1, 2, 3, 4, 5, and then there's all the weeks. So that's the average. As you saw, 5, 7 is the most. Yeah, so these are kind of insights you will get after just kind of digesting the market and just kind of like sitting down here and be like, what does this mean to me? First it'll be like, oh, this is a different language. Like, I don't know what candlesticks are. Like, why am I supposed to be trading this? And like, you know, can't I just like close my eyes and buy, or can I just like buy it once and like forget about it? You could do that too. But this is again like an acquired skill, an acquired language. Now this is not just the way you would keep it. You could also add RSI or MACD indicators, or you could add stochastics, whatever is your preference. You can layer it on top of it and see, okay, does it actually align with your trading strategy? The reason why I don't keep it personally is that I do see there's a lot of lag. For example, like if I was trying to buy through, say, looking at the MACD indicator, where like, you know, the 12, the 26, and the 9, so when they kind of like cross each other below the 0 is when it's a good time to buy, and like when it goes up is a good time to like start selling it. So at times, like I've noticed that it'll actually cross like a few candles down, like, you know, in the front, but then you miss so much if you move, because like you're half your, by the time you get an actual certain indicator signal actually to buy, you've lost like 3 candles. But if you look at this particular like strategy, not saying that this is a holy grail, by no means it is, but it just gives you like more insights into, okay, this is where it is right now. I'm not waiting for any lagging decision making. I can tell, looking at this is where I should get in and this is where I should get out. Okay, so let's move ahead. A huge crash for the week. I would say it's a big percentage drop, and so the markets usually have a hard time recovering or attempting to recover from these big drops. So it oscillated. It was a quick drop to the 50, moved up about the 20, and highly unlikely that it'll move back up here. But let's see. Okay, touch the 50 again, and so another lesson for you. So if it's touching the 50 once, twice, third time in the span of like 1, 2, 3, 4 weeks, the fourth time again when 1, 2, 3, 4, 5, 6 weeks, well, actually touched it twice. So what this actually is showing you, and I'm just going to like zoom out a little so you get a better idea. So is this better? I hope it is. But yeah, so now you get a better like visual of where the market is. Now if you I could just like mute myself from the video too, so that you don't actually see me block the charts. So maybe I'll do that. It'll give you a better view of like, okay, this is the trend in the market. You don't need to see me for the entire like video length. So let's focus on the charts. Okay, so how's this now? This is more clear in terms of like, getting a better visual. I've just expanded the charts too. So this is again weekly time frame. Nothing's changed. The market's just oscillating on the weekly. You can see there's a lot of selling pressure compared to the previous weeks. There's like more appetite, there's more risk, so whenever there's more risk, there's more market movement. There's going to be a lot more trends in the market. Markets are going to do a lot more, and that's where people again make a lot of money or lose a lot of money. So that's just something on like how the markets react in terms of like turmoil, in terms of when markets have a mind of its own, like recessions, wars, markets would move a lot. Okay, so let's move ahead and see what's happening. So I've let the market run, and the market, so it is on the 50 period moving average line, but I'm curious to know, is it going to respect it? Now, how would I play this market? I'm going to pause again. I would have bought, look at the previous one. Where does it respect the line? And that's where the next time it touches it, you would buy at that level too. Now this is a little like quick like dip, 2 quick dips, third quick dip. So there is a possibility that it may just like pierce through it because it's so respectful of this particular dip, which means it's the 50 period moving average line in any weekly time frame is a real good support, and it's respecting it. But however, I don't know if this is going to be a long time respect or it's just going to crash below it. But let's find out. Just something to keep in mind. But I would buy around these levels here, and let's ride the top, like to the top. Put a what is that called? Like put a trailing stop loss, and then like let it run from there. So yeah, I'm gonna let it run. I see it could possibly touch the previous high of this. If it can, it has so much of runway. Can't tell. No, it did not. So it actually moved up. This is another smaller square compared to the previous ones, which is not that good, but it's still respecting the 50. Like I'm surprised that it actually bounced out before this, not even touching it. But yeah, let's see what's in store. Give it some more time to fly. And these are really, like, I would say, tough spots to time, because it's not like really a good strong uptrend like you saw your like all the way to the top. These are small like hunchback trends. So it's gone up for 5 days, it's gone down for 5 days, and now it's where it broke it. So let me pause here. This is an important lesson for you. So what happened here is the market tried breaking it. This one was like a weirdo candle, because it normally would touch it again, but it was like, no, I can go up again. It went up for 5 weeks. It made a doji, and these dojis are important. These are like are sinful candles, in the sense that it would indicate that, okay, your upward trend's over, it's going to be downward hell. And that's what it did here. It's like downward hell, let's go down. And it did that. It like went down and went below the 50 period moving average line. So now that it broke below the 50 period moving average line, and how would you know? It's like, you don't just like short it your, because this would be a good time to short, be like, oh yeah, I would, it's gone below the 50 moving average line. No, the way you would actually short it is you would wait for this next candle the next week to open up either on the top or below it. So what I mean by that is I would not short it your, I would wait for the week to close, and the next week should turn red and move down below your. That's when I would short. So same thing your, like if this was your, and if this candle opened up your and went up, I would not short this. So I would wait for this candle to actually turn red, and as soon as it turns red, then I am ready to short the market. I'm ready to short the market. So okay, I'm gonna let it go down. Let's see how much more downward momentum it has. Another thing that I've noticed, and this is one of the reasons why I've kept this line. So this line that you see here, I believe it is the 100 moving average line. I could be wrong. I need to check on it. But I believe it is the 100. So let me just check. The brown one, properties, is the 100. Yes. And the reason why I have this 100 live and kicking on my chart is that because on the weekly time frame, the market seemed to respect the 100 a lot more than I had initially thought about. And I guess it's just that, after the 50, the markets are, or these big investor bankers are like, oh, what is the next line that I can get or try to find support on? And they're like, oh, the 100 might do. So let's add the 100 before the 200, because the 200 is so far away. Let's maybe see if I can like get the market to turn at the 100, and that 100 will make more other not customers, but traders to also join the bandwagon. So I'm speculating here, but sometimes, and I'll point it out to you, the market does respect the 100 too. So yeah, the market touched the 100s 3 times, touched the 50. It'll do that. It'll never just like, go from the 50 to the 200 unless it's like a really strong downtrend. But it'll touch it, moved up, touch it, moved up, touch it, moved up, and then it'll start going down. So it's hard to find good buying because it's a range, right? Like, so the best way to have shorted this would be, okay, the market's gone down, short this, but then the market goes up again here. So I would actually exit my position somewhere here when seeing that the market's going up. So I'd have a trailing stop loss. I'm put in here and I would get off here somewhere. I would be too hesitant to keep it until it actually peaks up all the way here. So some people would keep your stop loss here and like get it here, which is fine. As long as you're getting it closer to the 50 period moving average line, you're good and golden. Don't get it here, don't short the market here, expecting it to like go here, because that's where you're not getting it close to the mean or the strong EMA lines or the strong exponential and moving average lines, and you'd be into a loss. So other people avoid range trading completely and say, okay, I see this in a range. I would like it to break through the range, either up or the bottom, and then I'll get in. So some people would be like, okay, if it breaks below the 100, that's when I will get in. So different strategy, different appetites, you know, whatever fits your strategy is what you should use. So yeah, I see it breaking down to the 100. And I think this is where the market then goes into like a longer downtrend. Yeah, it's breaking it. Now it bounces back up, touches the 50 moving average, and now makes a bigger lower low. So, but you see these long wicks along the way. Like you see these long wicks here. This one is okay. You can navigate it. This one too. This one. So it's hard to trade these long wicks because your stop losses would get triggered. So it's really, really, really important to, if you were shorting it here, it was okay. You would have, like, you know, at least made some money. It's okay to short it on the 20 period moving average line. As I said, if it's the candles below the 20 period moving average line, then you short it here. But don't short it here. I've done that mistake so many times, burned myself. Don't do that. So keep it above. This one, you know, you would have kept it a little above that, but keep it above the 50 period moving average line, because sometimes it'll just touch the 50 and go down again. And this is, yeah, so if you were here and you were short at the market, like, you would have made like some good pocket change, and especially on the futures contracts, like, yeah, this was good moolah. So yeah, let it run. Now the way, let me just kind of like pause this one more time. So now you've got a good bear market downtrend. You know, at first you kind of like anxious, but you know, like, okay, it broke down your it broke down below the 50 period moving average line. Another way a lot of people trade is that they will look for these golden crossovers. So one of the golden crossover was like the 50 with the 200, but then if you want to get in early, you could do the 50 with the 20, and like that crossover was here. But the crossover was pretty low down, like you would have probably waited too long. I personally would have done like the breakdown from the 50 period moving average line, got in over here. Now you could have probably made a loss by actually, like, you know, but you could have also sold it here, gotten back again here. This is a strong line, and then ridden it down and kept your stop loss above the 50 period moving average line. Now that it's gone down so low, my advice would be decide what's your kill point, because it's going to bounce back, or you can always buy it back when it comes back to the 20 period moving average line. You don't want to just like let it come all the way back here, and then you basically lost so much of profits. So that's something that I personally would struggle with as well. It's like, you know, hey, I don't want to just lose so much of my profits that I was like, you know. So when you're trading, you'd be like, oh, I'm like plus 1 million or plus 10,000 or plus 1,000, whatever is your account size, and you would then kind of like end that particular week with plus 500 with how many zeros ever you want around the side of it, depending on the account size. But you know, you were plus 1,000 at this level, and now you're going to plus 500, and you would be kicking yourself and be like, why shouldn't I should have just sold it. So some people would have their threshold line as this 50 this 5 period moving average line, but it's hard because, like, you know, this one actually broke through it and then again went down on a daily time frame. When you're looking at these weekly charts, you would miss it and you would get topped out. So the more I guess the other traders would probably take the 10 period, but then you do lose a lot more. So it's, again, fine-tuning it to your strategy. I'm giving you a strategy that you could use, or you could have like a different way of like how you like to trade as well. So just food for thought. So I'm going to let it play, see what it's going to do, and see, it did break through it. So you could have either like stopped out here or stopped out at this 5 period moving average line and bought it back here. Now don't buy it just at this level. So I normally wouldn't just buy at this level here just by looking at it at the 20-period moving average line. And the reason being that, so here it actually pierced it, went back down. This one kind of like closed on the top of it. So if the market actually like, you know, kind of plummets so much, it doesn't really always mean that it's going to like bounce back from the 20-period moving average line. So just keep that in mind. It would possibly also go to the 50-period moving average line. So the way you would confirm it is, you know, either you buy here and like see if it goes up, or you short it here, wait for it goes down, or wait for the next candle and see like what is the direction of the candle. Like, is it going to go upper or like lower? Just get some trend direction and don't like just blindly go in, because a lot of people, me including, would get burnt at these areas, because you can write this down. Coming up, you'll be like, okay, it's going to fall down again, which it could, but just wait for a confirmation before just like diving into the deep end with a lot of like money and then like realizing you made a wrong decision. So yeah, I'm gonna wait for here. So it's kind of like bouncing around, touch the 50-period. It's getting closer to the 50-period moving average line, touched it there, and so let's see, like it's hovering between the 50 and the 20, still not too much of the direction, so it's still hovering around it. Like, just wait for a little more. So we'll wait and see what the market's going to do next. And so it's kind of like consolidating right now. It's heading lower, which is expected since it broke down below the 20-period moving average line. And it may just touch this bottom again. Now, I do notice that it's kind of crowding around the volume. So I'm just going to turn the volume off so it gets clean. And we can turn it on, because we're not looking at volume too much, because volume seems to be pretty stable. However, there could be charts, there could be different time frames where the volume won't be as simple as we're looking at it right now. And it may be more of a factor on the daily time frame or on the hourly time frame. But just keep an eye. Volume does play an important role. I don't want to just ignore that fact. So yeah, let's continue. We're going to let the market ride. So the market's heading lower. I do feel that the market could possibly touch the 1135 mark, make a double bottom like we've seen before. The market's done it a few times. So it did touch it, and I would be very hesitant to ever short it here. So I would short the market somewhere around this area. Let me just pause, because this is my sweet spot. This is where I would short the market. Not below, not your, but your, between the spot. So the market respected this. I short somewhere here, and I can just milk out all the profits all the way down there. So now again, you know, we talked about this where we are supposed to buy again when it kind of closes there. So keep that in mind. We need to figure out what's a good time to buy. So based on the previous change of events, I would say, like, you know, let the market turn a solid green. Oh, another very important one. You've probably heard of candlestick, like candlesticks and candlestick patterns. So a very important, we talked about doji, and I think we just came across the doji right here before it turned negative. Another important one is the bullish candlestick pattern. Patterns mean two or more candles. That shows you a way in which the market would move. So a bullish candlestick pattern is, this is a lower candle. The green candle would be bigger than the previous red candle, and that's a bullish engulfing pattern, which indicates that the market is in an uptrend short term, you know, wherever it heads to. Similar ones, I'm just going to go back in history, and I apologize for not telling you this before. This is a unique case, because it kind of shows that, okay, the markets did turn, but it's not as much. This is a bullish. Trying to see, this is a good example of a bullish. This equal, but Yeah, so just keep in mind at turning points, if you see a bullish engulfing pattern or the green candle bigger, and it'll be vice versa as well. It's just called like the bearish engulfing pattern, and that happens as well. So keep an eye out on that. That's an important lesson. And yeah, please take notes. Yeah, if you find something more, you can also pause this video and talk about it, or like, you know, kind of investigate why is it like that. So yeah, this went down. It's come up here. Is it breaking this gray line? So my take would be to decide or discuss the possibility of waiting for it to either go above this, and then I would short the market, like not short the market, I would close my position. But you as you've seen, like you've lost like 1, 2, 3, 4, 5 weeks just trying to. Let me just talk about this. This is an important lesson too. So the market went down. Now it did have a gap down, and gap downs are usually filled. You know, you never see a lot of these gaps just kind of remain gaps. So what happens is, if there's a gap into the market yeah, will kind of move down, and then it'll try to come back up to close the gap. And this is how it did that. It kind of like consolidated and closed and went up. So one thing you could have done is that shorted them, like basically closed your markets. As I said, like this would be a good time to get into the market because it's close to the yellow line, as we talked about. Not above it, because you don't know if it's just going to pierce out of it and go up there. But you know, somewhere around this line, like, you know, the closer the better. Either between this but lower to this, or like between this and the 10 would be where I would get in, ride it all the way down. And some traders would close their positions here. Some would say, okay, this is going to be like, if it's an equal candle too, it's like almost like a bullish engulfing pattern. So I would close my position somewhere around here. So or you could have your 10% stop loss pull you out. In that way, you don't lose all this. You know, this is like 5 weeks of losses there, because, and you know, something that you got in 2 weeks. So very important. Never let your losses override your gains, because it's painful, very painful. So okay, so the market's doing this. They're still 2001, December 2001. Market's still in not a happy state. Okay, it's gone up. It's hovering around the yellow period moving average, 20 period moving average line. Let's see what it can do next. I'm just gonna like let it go. Let it go. Let it go. If this was me, I would not step into the market until it shows me, is it going to like again bounce back down, or is it going to like bounce up to and touch the 50 or the 20. So now I would possibly get in, because it showed me one lower candle. Remember, we talked about this. The market will like, you know, go down once, and then it'll try to, and like this is like a sudden move, and then it'll come back up there, and that's where you can like step back in, because it'll kind of like touch it again. Now, two things to keep in mind: there's a consolidation range here, and there's like one more here. So two things that could happen is the market could just consolidate in this area, or it could just take a flip up to the 50, because it likes the 50, it likes to touch it, like this area here. It did do it, or it was trying to. I don't know why it could not just stretch higher there, but the lower bottom seems to be the 971. So I don't know, I can't tell you if it's going to be 971, but it's a good time to like get in with your stop loss around the 20 period moving average line above it. So you put your stop loss, you know, get in somewhere early your and honestly, it would be a little late actually getting in. Like, you know, getting in closer to the 20 is better, but then at the same time you might just get bounced out and like stopped out of it. Pros and cons. So let's see, has stomach to go down, or it's just going to like flip back up. So it did go down a little bit. So I'm curious to see like what's the level of like lower it could go. So this one didn't actually work out because two reasons. So I wanted to go and check the monthly too, but I think one of the reasons being that this was overextended for a long period of time. Now, another lesson is the markets, if they are actually bouncing down, so this is one bounce, two bounce, touch the yellow, third bounce, touch the yellow, fourth bounce. So if the market bounces like 3 or 4 times on the yellow, on the downside, and it could be the upside too, it will rarely, if ever, bounce back up to and kind of like make another low from the yellow line. So you should be cautious, like as I said, like if the markets really has some bad news, it can propel it lower, but it could also like bring it up here, and that's I think what happened here, because it was kind of like plummeting, going down, and the news brought it up again to like touch the 50 period moving average line. So keep that in mind in case. So market, as a recap, market touches the yellow line either in the uptrend or the lower trend, downtrend a few times in a row. Then the market will, so this is a flat yellow line, which is an indicator. Well, this is flat here too, but it's an indicator that there's no direction yet. You should not be trading on flat. As soon as it shows you you got in, but the market just kind of like turned like 360 on you, and it's because it's already overextended. So it's its way of like trying to consolidate, but just be careful. This was a rookie move, and I honestly have made it so many times. Like when I am trading with my own trading account, I've made that mistake too, where I would like, I want to step into the market now. I think it's got one more run lower in the market's like, nope, I'm exhausted. I need to just touch my 50 period on the 200 period moving average line. Or in sometimes the market will just like propel up from here and resurrect itself to the top. Now, if it moves to the top, the momentum in the positive direction will be really strong. And the reason I say that is because the market will have a lot of legs to climb up. It'll want to go closer to the 1530 very fast. So, just catch on to the train, because it's a fast train to the moon. But I don't know, there are times where this happens, but we don't know the real instance. So it touched the 50 period. It's a doji trying to decide what's going to happen. So I honestly would have been away from the market, like not take a direction stance until I know for a fact. So it's touched the 50, which is where it was heading, and now it may just kind of like touch back. I'm wondering if the market would touch this line now, the 1091, or head lower. So it's touched the 1091. And now the next one is right at the bottom here. So I don't know if it's going to do that. Maybe in one round, or maybe it takes 2 rounds. If it goes 1 round, then it'll like bounce up more. So let's see what's in store. So it's touching. Yeah, it's touching. So I'm thinking, it is going to go down to the 976, which it did actually at an intraday level, but it usually fills it again. So it normally gives you a good proper fill, and on an intraday basis, it may just touch it. Now, would this be a double bottom and like go up? No, it actually went strong down. Oh, another important lesson that I've learned, I want to share this with you, is so the markets know, like, okay, people are going to consider this a double top, and like, that's why it bounced so much up. Even year 2, they thought, it's going to be a double top, so let's rally it up. And this is where the institutions come in and be like, no, this is not going to be a double top. The recession indicates that it has a lot more downward push to take it towards. It's going to fall down, and they will like put in a heavy short sale so that it overrides this position. As soon as it goes below this previous low, it will start like tanking or sinking to the ground. So that's what seems to be the case here. So the market's done some heavy damage to the downside. Now it's heading up towards the 20 period moving average again. And now it's heading lower. So this time it didn't really even touch the 20 period moving average because the momentum so much, the 10's good enough for it, and it's made a new low. So yeah, if you were shorting it here, you could have like stopped out, got out of it here, waited for the turn to happen, because turn could have, like, it could go here, it could even touch here. So yeah, this one made, now this is a double bottom. This is a double bottom, and the reason why I say it is because you can see the market did not actually go down the same momentum that it actually went down the previous time. So, you know, this was a long stretch lower. It bounced up a little and went not too much, and then it bounced up again, and yeah, here is it. So now it's consolidating. I don't know if it has enough strength to go down further to make another new low, but let's see. I think it should touch the purple line because it really got overextended in the last run down. Let us see. So it's going down, it's kind of consolidating. Okay, it's making a new low. A lot of people would have shorted the market and got in there. Somewhere here. So it's making a new low. Yeah, I can't tell. So yep, it's made a new intraday, touched the bottom, and now it's going up to the yellow line. Yeah, in my opinion, this is actually too overextended, so I'd be cautious. Well, just like I was cautious here, I'll just like wait for, you know, the market needs to rest. So the market like bounced up, you know, kind of like did this jiggy here and like formed a double top here and then went down, touched an intraday, did a double, is it a triple bottom? And then like, yeah, so it's going up. So yeah, see, it touched the 50 and moved up. So what I would do here is I would try to get something above the 50. Now, not always does the market touch the 50 and like move up to the 200s. Keep that in mind. The market not always touches the 50 and goes up to the 200. It will at times touch the 50 and move to the 200, or it may just like hover on top and then bounce back again. It may use all these fake moving averages as like, you know, turning points as well. It's done that in the past. So keep that in mind as well while you are navigating or trading. So back to the market, like it's gonna go, okay, so it's taking a turn here. I just want to confirm if it's like a real solid trend down or it's going up. So I see it breaking it, heading higher, but I want to see like, okay, is it actually full positive momentum? So if this is me, remember I had mentioned before that the markets do touch the 50 and come down, so it actually breaks through it. It's a breakout, and then it kind of bounces and respects this and then goes up again. So that's what happened here. So it touched it, went up, touched the 50, went up again, and now it's touched the so I think this is the 50 100 moving average line. And as I said, like sometimes it will try to find fake lines to make or show that it is the time for a turn, but it's heading higher. So let's go with that. Let's see where it's heading to next. So I would have gotten your, and actually, you know, when you see these doji kind of lines, candles, I would have gone out from there, and it bounced on the 20, sorry, the 10, but it seems flat. Let me just get the volume up to see in comparison. Oh, volume's not doing too bad. It's still like pretty high. So touch the 20. So now it's, I just want to pause. I'm going to get rid of the volume. It's too busy. So what's happened here is that it's touched the 100 and it's now on the top of the 10 period moving average line. So it seems to be that the market's turned direction, which it should, because it's been like almost a couple years and it's been into like a recession. So that's the tone of like where the market has or was, and it's heading higher. So if you're an eager beaver, you could have like, you know, thought about, okay, I need to like think about buying in here, but I would avoid getting it in a range that's still not decisive enough. I would personally like to wait until it crosses the 200 and then, you know, take it up to the moon. So let's see where it goes. So it's heading higher, it's touching the green. So yeah, so this is like a change in direction, a trend. Now there's a huge likelihood that it may touch to the 200. Oh no, it actually, I'm surprised, it actually bounced out of the 150 line now. So they're trying to find like new lines to provide fake support. But yeah, it is heading towards the 200 line. Okay, so it's made its way to the 200. So I'm interested to see, like, okay, does it take a U-turn at the 200? So like I guess the way I would do this is like buy it somewhere like here, or like wait for a new like a breakout, but then you gotta like buy close to the 20 period moving average line, and then get this here. So some people wouldn't trade this. I would not like to as well. Wait for a good signal indicator, good kind of like positive momentum indicator, and then get in. Yeah, so this is where I get it. Now it could possibly go back down very soon. Markets do that when they break to the any of these big like important moving average lines. So let's see. How much can it have? So this is the 350, so this is the 250 or the 300 and the 350. I forget what they are, but it's, yeah, so it actually bounced out of this. Is it bouncing? Oh, it's crossing. It is crossing. Oh, so it did cross, and now heading towards the 20 period moving average line. So that's the area of support. It breaks through. It usually touches the 200. That's the typical. But now that the 20 periods there in between, it's taking some support there. Most likely may head higher above that. But let's see. So let's move ahead and see what's happening. We move to April of 2004. Sorry, not 2024. But okay, so the market's turning down, and it usually touches the 200 period moving average and then decides where it needs to go. So I think that's what it's doing. It took a break at the 20 period moving average, now touched the 200 on a daily basis, not really on a lower time frame. But okay, let's see what it's doing. So this was again like I would have bought your short, like sold your. Some people like to trade in both directions, and it's easy for some, it's tough for some others. Some people would be like, okay, now it's overbought, I'm going to short sell. You ride it all the way down. So it depends on who likes what. In this particular case, it actually touched the intraday on an intraday basis, and you will notice this a lot. Like, I think we showed up some examples where on a daily time frame, it just kind of pierces it through, but it took a long walk around, and this is for 1, 2, 3, 4, 5, 6, 7, 8, 9 weeks, and then it came back down there. So in that time frame, like the only way out was to buy close to this 200 period moving average on the daily time frame, run it all the way to the top. Now you would expect it to touch this, but this is where it touched on a daily time frame level and then bounce back again. So that's one way you could have done it. It's a little tough. It's not like a straight uptrend for like half a year kind of scenario, but it is what it is. So now let's see, does it actually hold on? So a lot of the traders would buy around 200 because it's a strong line. This one did break down, touch the 100 period moving average. Let's see what's going to happen. I'm surprised that it actually decided to pierce through the 200 so easy. Normally they will at least bounce on it a few times. Yeah, interesting. So it did hold on to the 100, and so it kind of like went into all the moving average territory, and it bounced up from there. So this is where I would kind of step back in and keep an eye out on the top line. So I'm going to just zoom out. I want to get a better perspective of like what's happening here. So it seems to be like range bound, and that's because we went into a mega year rally. So it's just kind of bouncing around, regrouping itself before it hits higher, which is expected. Yeah, this was an interesting move here. Yeah, I'm just going to continue, see what's going to happen. Did it break out? If it breaks out, it's a good positive sign, and I think that's what it's trying to do. So yes, it did break out. Showed some weakness here, but it's overcome it, gone up higher. And yeah, and as I said, like, getting it anywhere close to the 20 or 200, and then just this would have been like a tough point to either keep it at. But if you got it at the 50, that would also be a good sign. Yeah, so it's going up higher, moving to the a new zone, new territory. Now, another thing to keep in mind would be like, okay, this would be the 1297 level could be an important milestone. This is where it decided, this range is where it decided to like take a break on. But it won't go down like considerably. It'll keep touching itself to the 20 period moving average line and then bounce its way up from there. So to that here, And now let's see. So now it's trying to form like a double top maybe. Let's give it some time. Let's see if it's like, just trying to consolidate, see if they can break through it. If it breaks through, then yes, there's more positive gain in store. Yeah, I'm gonna give it some more time. I'm just zooming in so you get a better picture of what is happening. And it broke it. So I wouldn't consider this, well, it's almost a double top, but yeah, it showed signs of weakness. Nothing really of strength coming up there so far, because this should technically be higher than the previous high. So it's not done that. It's gone to the 50 now. And it didn't really have like too much of a reason to touch the 50. I would expect it to go touch 20 and then move up from there. So yeah, let's look at it. It's got touched the 50. Is that a sign of strength? Sign of weakness? Yeah, so it seems to be a sign of strength. It's bouncing out of the 50. I think it's kind of following this pattern because it bounced at the 50, went up there, touched the 20, touched the 50 again, and it's gone higher. So again, like buying near the area of strength, the 50s, is a good move. Now again, it's a big strong resistance up here. It's gone down lower. Not sure if it's gonna break it. Touch the 20. It's a lot of positive momentum. Yes. So some of the breakout traders would actually get in over here as soon as it breaks out, but sometimes when it breaks out, it'll kind of like come back down. So that's another thing to keep in mind. So it's it's better, or it's more wise to buy it at the 50 period, or if you can at the 20 period, but not when it's in no man's land near the tops of these ranges. And yeah, so this is really not the most ideal like uptrends, like as you've seen here. Over here it seems to like just kind of like pop down. It seems to be breaking itself, touching the 50 period moving average lines pretty soon, without enough of strength. So yeah, so this is the third time. Wonder if it's going to break it. Okay, it did break it. So I think it's following the same pattern about the 50, 50, 50, and it's trying to make new highs. Really stingy in its upward trends. And so it's something you need to also be mindful of is what's the next level. So the 1296. This is where it is right now, but yeah, around this area is where the market will. Yep, it touched it, and sometimes on a daily time frame basis, it may even touch the top. But yeah, this is basically where it is right now. So if you can't see what I'm pointing at this high level. So the market's trying to touch that level. It did it. And now it's like, kind of forming a range, because this is like a big resistance for it, and the next one would be on the top here, 1364. So people, the breakout traders would like just wait for the candle to close above it, and then head here, and then they will keep it to this level, and then they keep like climbing one small peak at a time. Yeah, so I'm gonna let it ride a little higher. But yeah, like getting at this 50, or even like if it consolidates and getting it around where the 20 period moving average line touches is a good wise move, because it'll help you to at least ride the trends, and even if you lose, you won't lose too much because it's your stop loss or your mean average price is above the 20 period moving average line. So it gives you more confidence to keep it longer, and if you keep it longer, then you do have like some more gains coming your way. However, saying that, like, you are waiting for a long period of time, and just like, see, these two candles can like wipe out your entire gains. So yeah, so something to keep in mind, like this is really choppy, like uptrends, not a lot of let me just check the volume here. The volume's still like doing pretty good, but yeah, it's not really ideal conditions. So me looking at this in 2022 is like, wow, it's so easy to really trade today's markets versus how it is or how it was back then. Yeah, it was really treacherous in the old days. So yeah, tough days.
Now, as we move ahead, let's see what the market has in store. And now this is way back in 2006. Let's play it on. Let's play it on. So the market's taken its hold on the 50 period moving average line. So anywhere around here would be a good time to buy, and that's just looking at the previous historic. This is the respected line, the 50 period moving average line. What I would do is like buy it around this line and keep a trailing stop loss. Now it can be tricky because your trailing stop loss would be, you have to give a good cushion, otherwise you get stopped out for a loss. So it's a fine line between risking some profits versus getting a loss, or just making a small chunk and then the market just kind of goes up after that. So something to keep in mind while you decide on your risk to reward ratio, but there is no better place than buying it around here. If you buy it here and it just kind of dips down, you're at a loss, like, for sure. So yeah, the market's heading up. Let's still wait, like, analyze, scope the market out. This was a good rally up. It's been not consistently like positive weeks, but you'd say 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15 weeks, 16 coming up. So it's a really good rally for, I would say, a couple months, few months in a row to get up to that level. So we're gonna let the market still, like, as I said, like this, if you had to buy your, you were gold, you would make a significant profit. Now some of the other traders would be like, okay, I'm gonna buy your at the breakout, and that's good too. You choose your strategy based on your trading appetite, what is your risk reward ratio, what feels good for you. But these are just like different ways you could trade the market. So the market's heading up here. Now you could always layer this as the market's just kind of consolidating in this range here, so I would keep the gray line, which is the 10 period moving average line, as my stop loss. As I can see, it's actually touched it once, bounced back up, so that's pretty strong now. Market's respecting it. If it breaks through, I'm out of the trade. That's how I would trade this particular. Oh, this was a fairly quick sudden drop, but it was expected. Like, you see these consolidation patterns here, that's an indicator that the market's exhausted. It's gone up too much, it needs to consolidate. So some traders would be like, okay, as soon as it crosses this line, I'm going to short the market. I would avoid doing that, and my reasoning is that if the market's in a bull rally or it's in an uptrend, these short downturns, the market could just like touch the yellow and then move up. Or in this case, it just kind of hovered almost to the purple and then moved up. So you don't want to risk your money shorting the market. So another lesson, if you could take down, would be decide a direction of the market and only focus in that direction unless the market has changed direction. So what I mean by that is, if the market's in a bull rally, just continue buying the market rather than trying to find short selling opportunities. If the market is, or the stock that you're trading is in a bear market,
avoid buying like at the dips, or like just trying to kind of like trade in the reverse direction, because the moves downwards won't be in proportion to the upward moves, and you might just come in at the wrong time and you would regret the decision. So yeah, just some food for thought. Now, as you can see, it took a break, it took a breather here, and like it's gone up strongly again. So now it's respecting the yellow, which is the 20 period moving average line. So see, over year two, it touched the line and then bounced back up. So so this brings up a good question or thought about scaling. So you might be asking me, hey Sheldon, I like the idea of, okay, trading closer to the 50 period moving average line or the 20 period moving average line, but I'm not satisfied because I went in once and I'm just kind of like going out. How do I multiply? How do I compound my my gain? So for example, if I bought it here and I decide to hold on to my profits until it comes here, and I'm like, okay, now I think it's a good opportunity to buy again because I'm here for a long-term trading perspective. I'm not here just to trade a few weeks for a few months. I'm here for the long run. So how do I do that, Sheldon? And the answer to that is you could buy your, if this is like your buy opportunity. Now, if I just zoom out, because this is such a big, nice bull rally, it's a meaty bull rally since it bottomed out here. So I would not recommend like, trying to scale up at this level, because you don't know, is the market actually out of it or no? So your would be your first buying opportunity, or some people would kind of like either scale this up, not scale this, but just kind of buy this or ride this up, wave up, sell it here. And so if you buy your, you kind of see, okay, the market's respecting this. Maybe this is a buying opportunity, maybe I'm not sure. So this would be like your first contract, second contract. You kind of hold through third contract, fourth contract, fifth contract, and then you were like, okay, I want to go sixth contract. So what I mean by these contracts is that you're scaling up 1, 2, 3, 4, 5, 6, 7. So whatever, if you're trading the futures market, that's contracts. But if you're trading a stock, and just example, this is like Apple, you would go in as 100 shares of Apple, or like 50, whatever is your account size. Now, something to keep in mind, take a note of this, is don't ever invest or trade more than 2% of your money in one particular trade. So what I mean by that is you don't want to invest or trade, like if you've got like say $1,000, the maximum you should be putting into one particular trade is anywhere between 2 to 5% in that one particular trade. Now you can scale up from it if you're in profits, and that's fine, but don't just kind of go all in. Like don't put in like 20% or 50%. And some people actually do 100% of their entire money into one particular stock, and that's too risky, because if there is some bad news that comes out after market and you don't have the access or the ability to get out of your position in time, or say you're on vacation or you're attending to some family matters and the market turns on you, you would not have the time to react to it. So be cautious, like diversify. Now the sweet point, again, another note to make is always try to diversify. The sweet spot is between, some people prefer 6 to 15 is like the sweet. Some people, me personally too, I do not like to keep more than 6 or 7 the most. And the reason being, like, you've got too many, like, I guess people are like stocks or like futures or whatever you're trading is to manage at the same time. You can't keep a close eye on it. So I would say 6 to 10 should be good. If you're a long-term trader, don't really actively look into the market, then I would say 15, but avoid going more than that, because then it gets too overwhelming. And unless you're like, a portfolio manager that has a hawk eye on this on your entire portfolio throughout the day and that's your full-time job, then yes, sure, go ahead and do it. But what I'm trying to teach you here is so that you don't really spend hours and hours and days of your time stuck to your trading charts. Like, you should have a trading stop loss and just let the market do it. Like, let it be a passive income for you. But you've got your stops in place to know when to get out of the market. Now, having said that, like, if you want to scale it back again, you should know these points. You should know what would be a right value to get in. Sometimes you could just put a buy limit order, and those work wonders too. So it's up to you, like, what is your pace of trading? What do you feel is a good a time period to step into the market? How much time you should allocate to it? So it's all like, kind of tweaking to your taste. So back to my point, scale up. As you see the market respecting these points often, that's a good time to scale up. So one stock, like 100-year or like 10-year, whatever is your appetite, go in. But another point, when you're scaling up, don't just scale up more than, so if you bought one in the first point or the first entry point, don't buy 5-year, buy one so that it averages this out. So in case if the market falls down, it should not be break even, because you kind of lost all your whatever you've earned there. Now, another way to like trade this particular strategy would be, okay, I buy here, I'm going to get out at a certain value, I'm going to wait for the market to retest the low and then buy again, and then again do that for every cycle. And some traders love that approach, because then you are making a sizable chunk, waiting for it to like kind of go down again, another chunk. Some people find it hard to really get the entire move, and they say, okay, I'll just like wait it out and like gather profits as it comes. Some will say, okay, I'm just going to buy it at the lows and just like wait and ride it out for like a few years. So it all depends. It's all relative to your trading style and how much time do you have to invest in the market. So I hope it makes sense in terms of like how and where you should be getting in. So scale up gradually, never overscale, and try to like not lose your money. So like, for example, if you bought your and so say for example the second time you bought your and you're still in profit. Now if it actually fell below, you should not be losing all the money that you've made in the previous two, like, because it's a long period of time. So be cautious about that. Don't just like let the market take all your gains away. So keep a profit target and like kind of hold on to that. So say that you should always move your stop losses up after you gain a profit. Never keep it into like the loss territory. So and if you do a trailing stop loss, it does it for you. It keeps moving up as the market moves up. However, if the market was to go down so much, like 3 candles or just 3 weeks, you would have got stopped out if your percentage was a small tiny percent. So that's one of the cons of it. You can also have a manual stop loss where you can kind of like move it. Okay, I'm going to move it below this line, and then it breaks through. Okay, I'm going to move it over here to this line. So that could be another strategy too, but the most preferable way is if you're an active enough trader, and this is like weeks, so you're not actually looking at it, you're probably looking at it a couple times once a week. That's good enough for you as well. So 1 week would be this candle. So I think that's a worthy investment. Like if on a weekly chart, if you can just look it up a few times a week, not active daily, like kind of gauging through the charts as every candle on the 1 minute time frame like passes, this is good enough. So I would say, yeah, leave the market here, try to get it back here as it holds this line, leave the market here or like somewhere here, you get this kind of gain, buy it again here. So you're more active, but it's your choice. Okay, back to where we were. I'm gonna again move this ahead. So the market's actually taking a big nosedive again, and it's holding on to the purple line. I'm Now, if I was a trader here, deciding now, okay, the market's held the purple line a few times. Now, an important thing to keep in mind is the market rarely, so in this case, it touched it, the next candle moved up. Okay, that's good. And it only does that at the start of these rallies. As it moves towards the end, you'll see a lot more consolidation on these points. And that's something to keep in mind because you see, oh, it's touched it, and I want to just go back into it. So this would have been like, you would have bought it somewhere here, but the market went down here and you'd be like, oh, is the market going to fall to the 200 moving average line? So that's going to be something that you would contemplate and wonder, is that a good time to get into the market, or like, why am I in now? So I would advise you to look at the closing of the candles. If the market touches it and just bounces back, we talked about it so much in the past, don't just assume that the market's just going to bounce back. It does it sometimes, but not always. So wait for the candle to close below. So in this case, it closed below, but I would like the next candle to actually close or like show red and like, kind of like move in that downward direction. And that's where I'll be like, okay, the market's heading down, not upwards anymore. So in this case, so this candle was the one that actually was on the line. On the line doesn't count. This one was also on the line, but it was kind of a little lower, still doesn't count. It should be completely isolated from the line. That candle is what I would say as, okay, the market's changing direction. And a lot of traders respect that rule, and that's the reason why they will avoid buying just on the line, especially in these consolidation periods, because if you made some gains here, you would just like, accidentally close it. Now, the best thing to do was to buy it here and not just buy it, say, when the market went up here, thinking, okay, it touched it, and you bought it here, and then you'd make a significant loss compared to buying it here. And your stop loss, now there's different ways. So again, me just digressing into stop losses, and forgive me for talking about so many different topics. I'm just trying to make sure I do not miss anything. And I've been studying trading for like years too, over 15 years to be exact. So as I read, I'm kind of recollecting certain key points that will help you to become a better trader. So as we're talking about backtesting, I hope you're taking notes down and saying like, okay, this is something that Sheldon mentioned, I should keep in mind. This is something that I need to just backtest. So don't just believe me. You look it up and like test it too and see, does it really apply? And this is something you don't really out of second nature just be like, oh, I noticed this happen. And in the comments, if you can, just mention or let us know as well if there are certain things that you observe. Like, it should not just be me feeding you. You've also kind of had an experience with trading. You share that with us too. So it's like, a give and take. So back to where I was, what I was saying is that there are times where the markets would kind of like go down to a lower level, let the market just kind of close down below it. And if it just kind of like closes down completely below it, and makes a new candle out of it, that's when you should assume that's the direction the market's heading into. So don't just like wait, or because on a weekly chart, the market's just kind of hovers around this too much, and you may just get stopped out, not sure where you should step in. Now to my stop loss point. There's different ways on how you could value or add a stop loss to a chart. Some ways you could do it is by an ATR, which is the true range indicator, average true range indicator. And that's one way people do it. It's a different, you can get them on any TradingView has it, all trading platforms have it. And you could just look it up, how to add ATRs as a stop loss. And that's one way, because different charts have different ranges and how volatile they are, and that's how they would calculate it. The other simpler approach, I personally don't use ATRs. I find it too much of a hassle to just keep like trying to find it that way. The other way is just have a fixed one. You kind of know, like, okay, I use trailing stop losses too. So like I know, like, okay, for this particular chart, which is the S&P, a 7% range would be good. Or if you're trading weeklies, you know that you can expect this much of a move, so you shouldn't be like, always getting stopped out of it. So or you can keep a fixed stop loss just below it and say, okay, anything below this I will, like, not be okay with. And that prevents this range from kind of like eating you up in terms of stopping you out. So different ways, there's different stop loss strategies. That's a different course in itself. But just to educate you, like, on how or what people use to prevent, but to my point, always have a stop loss. Never ever go in without a stop loss, because there could be the World Trade Center crash. There could be any major world event, and you'll just come home one day and you'll see, like, oh my gosh, like, you're in such a big loss. Now, the markets usually don't just tank like that in a day, but it does happen. Like Black Monday was an example. The COVID lockdowns were an example, but that happened over a span of a few days or months. But just to be ready, like, always have a stop loss. You won't regret keeping it there. Sometimes it may just stop you out of it, but don't keep it too wide as well, because it may just eat into your profit. So buying it at a good peak time. And a lot of people say it, like, timing the market's not possible, and it's true. But these strategies, or this is the time that I'm spending here educating you about markets, is so that it enables you to better time the market. And the people that actually say timing the market's not possible are the people that look at balance sheets, the people that look at just the fundamentals of the stock and say that, oh, I'm just going to buy it at the mean average price. I'm not just going to buy it at its peak, which is kind of like trading, but they're looking at the financials or the actual stock, but not looking at the actual chart patterns per se. So I would say, like, keep an eye on the charts too. This methodology, the reason why it's bouncing out of the 50 period moving average line is not by fluke. This doesn't just happen for for the sake of it. It's because other people too are respective of these trends. They are following it. So just join. You don't need to reinvent the wheel. Just follow what the others are doing, and you'll be successful. No trader can be like completely separate and like have a completely unique strategy and still make money. Now, there are algo traders. There are different ways of like how they trade, but they also use a similar approach, or it's the same stock, like, or it's the same chart. Like, they don't trade something special. They just have either tighter stop losses. They have a way or a mechanism which could be completely automated on how they trade the market too. So I'm going to move ahead. Enough of me talking about the background. So you can see this was actually a really tough one to get into. So you would have, if you had a stop loss below this, you would have lost money. But I would not advise you. So as I said, like, the market just doesn't touch this and bounce back. It will kind of rest in this period for a period of time. So some of the traders, I'll just stop here. Some of the traders will say, I will only buy if it goes above the yellow period moving average line. And that's a good strategy too, because and you wait for the candle to close above before you buy, not just this, because this is like an intraday. This is an intraday. Give it some time. Whenever it kind of like drops down, like as in this as well, give it some time to breathe. Don't just rush into it, because when the market makes a big fast move, it needs some air to breathe, and that's what it's doing right now. It's like I'm just kind of breathing right now. I need some time, some space to collect my thoughts, introspect, and then I'll decide what I want to do next. And that's what it's doing here. So you can see this is another pattern that we just identified. So let the market just come up, and that's when you can buy. Some of the smart traders would be like, I know it respected it so many times, I'm just gonna buy your now the stop loss would have kicked you out, and this is the 100 period, and you'll notice that the 100 period moving average line is respected several times. Actually, you know, you'll be surprised, and that's why I've kept it. I haven't like bolded it on this chart, but I've kept it because it seems to be respective on the weekly chart time frames. So it did that, and then it kind of like hold its ground and went higher. Personally, you could either buy it over here and say, okay, you know, I'm going to just take my either keep the stop loss below this line, but it's a really risky, you know, move. I wonder if this was like intraday maybe, and that's where it actually, you know, went down, or this was like after hours. There was some like significant news. Don't really know, but let's move higher, upper, and like so. This is actually where you could step in, and I'm just going to let it flow through. Now it could possibly touch this and then bounce back and make a double bottom. It has gone through a huge rally, or it may just keep going up. So it's important to keep an eye on this level, because so see it went up a little and then it crashed down again. So see, as I said, like just keep an eye out on this level. It doesn't always match completely to this level, so this could be considered a fake breakout. It just went up and the people were like, oh, I want to go in. I want to quickly look at the volume here, because like, you know, so the volume wasn't significant, but this doji had nothing really significant to talk about on the volume front on this one. So okay, so it's again back to this weekly chart. So we would have bought here, sold it somewhere here because it's close to this line. You see it hovering. This is like a doji, not so much, but indecision here. I would have got out of it here itself, because I know this is like a top. Let it ride down. Now this is if the market actually just does one top and you don't see enough strength to take it further high after a consolidation, after touching the 50 period moving average line, it indicates weakness in the market. So now we're heading into 2008. Now we know what happened in 2008, but it was a very strong bull rally for a few months, and for a few years actually, since the 2000 crash, and now it's kind of like gasping for it. So keep an eye out on this. So this is not a time, you know, if the market was to go up again. And another like thing to make a note of, you notice the market should not go up in these big candles. The first candle could be big, and that's like, you know, an indicator of a bullish engulfing pattern. This one is a bullish engulfing pattern, and it could do here as well, bullish engulfing pattern, bullish engulfing pattern. Those are good, but after that the market should not just like take leapfrog ahead. That's a bad sign. So make a note of it. You will notice it in a lot of other it should usually like go up slowly, and that's a good sign, healthy sign. If it just leapfrogs, this one too, it tried leapfrogging, not as much though. It tried a little bit of a leapfrog, not so much though. So I would not consider, but let me just give you more examples. So this is also like I would say healthy enough, not super long. Like the two big ones at the start are acceptable, but then like it should kind of like slow down. If it just keeps leapfrogging so much into the top, that's a bad sign. That means it's the end of a rally. So oftentimes you will see like a big candle at the end, and then you'll see a doji, and that means it's the end of a rally. So big rally and big candle and then an end, and that's the end. So yeah, some things to keep in mind. Candlesticks, there's a lot of books to read about how or what do the candlesticks actually tell you, because these are the not lagging, but these are leading indicators. Like you can just look at these candles without any indicators on your screen and forecast what the market's going to do. So it's important to study these and like predict, or help you predict, or like guide you would be a better word to use, on what the direction of the market is. So as I said, 3 big candles, not good, means it's weakness coming through. It did that, bounce back. Let's see what's going to do next. So it went lower. If it breaks down and say the second one's going down too, then I would start shorting the market. Now your question would be like, is it too far away from the purple line to get into the market? And my answer to that is yes, it's too far. It's too far. And this one would be like a false signal. Like, you'd be like, oh, I'm going to get in here. It's actually closed below. Sheldon said it didn't touch the 50p moving average line. And it's a perfect opportunity. And the next one just like stops you out. The market does do that at times because it's kind of like changing direction. If you notice a truck, an analogy of a truck trying to take a U-turn, it just can't take a direct U-turn. What it does is it'll actually go back and forth and will like try to like maneuver itself and like try to and this is a 16 wheel tractor trailer kind of truck, and it takes some time, and this is a big 16 feet futures S&P on a weekly time frame too, so it doesn't really like just turn on the dime. And that's what it did here. It's like, this would be like a false breakout because, this is where I would want to get in. But it would take you out. You could have made profits and then your stop loss would have, trading stop loss would have protected you, but very risky. So it touches this again, and this is where it formally decides like, okay, now I'm turning, I've got the turning radius in and I'm in. So I hope this makes sense. But it just doesn't fall like out of the blue into like red territory or bear market territory. It'll like take a turn, and you'll see that in 2022 as well. Like the market just didn't fall down from like the top peak. It took a turn, and that's where it started heading down. So it did there. So it's hard to tell what would be a good entry point. Now, I would keep an eye out on this radius. So it's actually, this is the radius it's respecting, and I see it going down. If you were smart enough and you've got enough experience, then you could have taken it here. But that also breaks my rule of like, oh, Sheldon, wait for the market to turn. This could be a consolidation phase. It is tough. It is tough, honestly speaking. Like, you need a lot of practice, a lot of time just studying these charts to tell where would be a good time to get in. So yeah, get in wherever you feel is comfortable for you, but stick closer to this line. Now the market may also like come here and then bounce back and touch the purple line and then go back down again. So if it touches the purple line, that would be another good buying opportunity. I would avoid getting it somewhere down in no man's land. Not close to the blue, not close to the purple, in no man's land. Don't ever get it there. Even though there is this 100 moving average that I respected before, the green, which is another moving average we don't talk about. I think it's the 150. So, but don't get it though. Those are just guide rails, not actually something that the other traders respect. So either get it here or wait for it to turn. Avoid getting it here because there's no guarantee, or you might just lose a big chunk of your profits. Okay. Back to it, it's heading down lower. Now the markets will respect the 200. It just took an intra on a daily based time frame drop, but it'll respect the 200. So it will for some time. You'll see it just kind of hopefully consolidate and just kind of hover around the 200 as it decides what it's going to do next. As I said, when the market moves down for 3 consecutive weeks for such big strong moves, it's going to breathe a little. That's what's doing here. Now it's showing that it's broken it. I would get in here and say, okay, it's the time and like to go down, but it's also very risky. Like you would have your stop loss here and just kind of like map the market out. But yeah, I would have personally gotten over here, kept a trading stop loss, and then if it was going back up again, I would have like stopped myself out. So a week or two, but this was also like as I said, the ideal way would be to wait for this candle to open lower, but it's also too soon. There's not enough breathing room. So like that's another thing to keep in mind. Like if it falls like that, it needs some breathing room to like digest before coming here. And this is what it did. It actually, though it broke down, it went back to the purple line as we were talking about before when it was falling here. I said like it may go back to the purple line. So this is a good time to buy. Okay, this is a good time to, short the market. And the reason being is that, so this is where the tractor trailer is turning direction, touch the purple, touch the blue, which is the 200, touch the 50, and yeah, I would actually go heavier. Not so heavy here, but this is like me just trying to feel like, oh, how's the market just kind of dropping down so much, the 200 period and whole line. And now see the plummet. And this is something similar to what we've seen in the 2022 crash as well. So yeah, history repeats itself. And it's not just history. And it's not something that, oh, the market's just like falling down on random theory. No, it's actually respecting, or the traders are looking back into the past and saying, oh, how did the market turn? What strategy did that tractor trailer use to turn in the previous months or the previous years? And we'll do the same thing, and that's how the market follows suit. So now okay, let me talk to you about this. So this is the first I would say this is a more significant bear market than the 2000 crash that we've seen. You will notice that the market's really trending lower now. So, you can see like the turning of the wheels. So it's a few pointers to keep in mind. So now the strategy that I'm trying to educate you on, and it's again not the holy grail, it's just that buying it at areas of value and selling at like, overextended areas. Like, it could be anything that's considered overextended. That's where you sell. And like, the more you do it, it'll compound in time. So you bought it here, which is a good thing. You sell it probably over here, which is a good thing. This was a tough trade. The market was actually turning direction. So you would have shorted it here. Now in hindsight, yes, you would have shorted it here. Over here it's just kind of like hovering around. This is a false breakout. Okay, it turned here. So one shot here, if you were really a good trader and predicted a recession coming up, this would be a good time. The second would be, you could just ride this down, ride this, but then got faked out over here. Some of them would buy here and be like, okay, I think it's going to head towards the purple line. That could be a good strategy, yes or no, because sometimes the market may just touch the yellow line, which is a 20 period, and be like, okay, I think that's enough for me. But generally speaking, and this is another note for you, if the market does fall considerably and touches the blue line, or it's a big drop, the market does have a tendency to go ahead and pay its respects to the 50 period moving average line, and that's what it's done here. So it's not just random coincidence that the market turned at this. It's because people are paying attention to this line, and that's why it's turned here. So this would be another good time to short the market, as I said before. And now anywhere close to this yellow line would be a good time to short, because the market won't again go so soon to the purple line. So I would say if you see it going up, touching the yellow, that would be a good time. And now it's touched this, so this could be a bottom, a double bottom, but let's see what the market has to be in store. But you have your guide rails on how or when to exit. So yeah, it seems to be touching it, hovering on it, and it took a big drop. So it seems to be really volatile now. And this, oh my gosh, this was a huge candle. Wow. And it's really hard to trade this, to be honest, because if you bought somewhere here to this yellow, you were safe. If you bought somewhere in between here thinking like, okay, this is a breakout strategy, this would have killed you because you would have lost so much of profit. And yeah, you could have like righted this down, and then like, it'll kind of like reverse itself back. So this is really tough to trade. There could be a day that it went up like 3-4%, it went down another 3-4%, and that's what created this candle. Let me just show you. I'm gonna quickly go into the actual time frame, I just want to show you what this looked like, because this is an important lesson for you. So the market, now this is the daily time frame that I opened up for you. The market did just drop down, and again, it's hovering around the purple line, purple line, purple line. It dropped down, and it then bounced up to the this is the 2-day big bounce up, and then it fell down again. So yes, you could use the daily time frame, and this is what the daily time frame should be used for, guiding your entry and exit points. However, your eye should always be on the weekly charts for like the long-term direction. The daily time frame, if you're looking in this piece, like you would not tell like, oh, what's happening here? It respected the yellow, it went to the purple, kind of choppy, you're up and down, up and down. So you saw how clean the weekly charts were. So always have your eye on the weekly, but in terms of entry and exit points, use the daily, but keep the weekly in perspective as well. So again, you'll be like, what does this mean, Sheldon? Like, why are you taking me to 2 different points? So I would say if you were trying to get in somewhere at this yellow line, but then what you could do is, so this is the top. I'm just trying to see where would this top be. You would buy it anywhere on this purple line. So in the week, it's really hard to figure it out, but buying it anywhere at this level would have saved you a lot of regret. So this is what I mean. So you have like a few days to figure that out. On the weekly time frame, it doesn't give you like that opportunity. There's too much of chaos happening here. So as long as you know it's closer to the yellow period moving average line, and it always translates down to, so if it touches the yellow, it means it's going to touch the purple in the daily time frame. It's going to touch the blue, which is the 200 in the 4-hour time frame. So it's always kind of like in perspective to each other. So it's touched that, and now it's heading lower. So yeah, something to keep in mind. It'll help you, know and time the market by looking and focusing on the daily as well. So okay, I'm gonna move this ahead. We talked about the huge drop, but if you get it somewhere here, you would have been, but you gotta have the strength to hold on to the trade, because and yes, you would have milked a lot of profits. And not the right time to talk, but you could also like trade other commodities, trade other like different sectors. It's a different video in itself I should do, and I don't want to like bore you on that right now, but don't put all your eggs into this basket and be like, okay, the S&P 500 is all that I want to trade. So here the market's just kind of like took a big leap down. It's breathing. I would hesitate actually getting into the market somewhere here. I would like close my position, because it's overextended now, and the tendency would be to go closer towards this line and touch the yellow. It'll definitely touch the yellow. It needs to breathe some. So yes and no. You could probably just put a trading stop loss and ride it, and wherever it kicks you out, you get kicked out. But there's less likely it'll just like fall from it's too overextended. So I see it coming more towards the yellow. Now some people would be like, oh, can I like just buy and like wait for it to get to the yellow? No, don't do that. It's a risky maneuver, because you don't know. It's a bear market. You don't want to buy and like have a false anticipation. Like over here, it didn't go to the yellow, it just fell back from there. So keep that in mind. So here it seems to be like a very strong bear rally, because it just held on to the 10. I think I showed you an instance in the past too, where it just held on to the 10 period moving average line and just fell down. So that's what's happening here, and it's a crazy drop. And it's like you could buy close to this point, keep a stop loss somewhere at the top, but it's also risky because you don't know, like it rarely ever would not touch the 20 period moving average line. But this is a strong like drop. So it did that. You could have made some money here if you were smart enough, or you would just hold out until it touches the line and then you get in. Now I want to just stop here, because this is an important lesson. Would you be interested in shorting the market here? what is your thoughts? Now, if this was a live trading session, yes, I could have actually, seen your responses and like told you, oh, that's perfect, that's really what you should have done, or no. So my thoughts, and you could just like kind of wait. As I said, like the strategy would be, okay, it's gone your, you could either keep this as short the market your, keep your stop loss at this level, and that's good enough as well. So you got a perfect entry if the next candle opens lower your goal. So that could be one way you could look at it. The second would be, okay, I just want to wait a little bit and see for a fact, is this next candle going to be up? So if the next candle's up, then you buy, and then you wait until it rises to the 50. Or if the next candle is short, you can wait for it and then you go there. So waiting for it may not give you the best entry point, but it may help you to it may just help you to avoid just your stop loss getting hit if it moves in any other direction. Now the best time frame is to go to the daily and be like, okay, I want to get in now. I'm just going to find, and you can just put a buy order good to close and keep it limit buy order, and keep limit sell order if you're trying to sell, or limit buy order if you're trying to expect it to go up there, and let that ride itself so that you can make some profits there. Now your question would be, Sheldon, is it a good strategy to buy right now when the market's so low? If it heads up here, I would say yes, because it's so overextended, and it actually did go up for actually 4 or 5 weeks. So maybe not the best idea to let it ride further up. But I would just wait for an extra candle for confirmation to decide on what to do next. So I'm waiting here. It's just kind of deciding on what to do. My gut's telling me like the 50 periods where it should head to, because it's been down for so long. And yeah, so if you were to buy it after just waiting for an extra candle, that would have been ideal as well. Sometimes it doesn't just go directly to the 50. It will come up, touch the yellow, and then again go up to the 50. It may do that as well. So this one didn't really do it. It just kind of consolidated because it was in a big, they call it dead cat bounce, and this is what a dead cat bounce is if you ever see it on television. Yeah, so it's doing this, touched your, didn't really, so if you were to buy it your, this could have probably killed you, or you could have got some profits here and then just stopped out of it. But if you can notice it, it didn't really have enough momentum to take it all the way to the top. And the reason being, it's the market's very fearful right now. There's not a lot of buying momentum because of these red days here. So this is buying, but it's smaller in volume. You can see it's smaller in volume. So if you see the volume actually spike up, and that's a sign that the market's kind of heading into bull territory. So yeah, I'm just going to let it go. So it touched the 20 period moving average line, didn't do it here. It did it here, and now it's gone to the 50 period moving average line. So that's typical. And sometimes it's hard because you'll be like, oh, I wanted to go straight out to the 50, and it'll kind of eat you out. But yeah, touch the 50. It may again do the same thing where it'll kind of go up and touch the 50 again, and then go to the 200, or it may just go directly to the 200. It just depends on what the momentum is in the market. So yeah, you'll see baby steps. Baby steps is good if it just kind of spikes up. As I said, big candles, that's a sign that it may just fall down again. So yeah, so me wondering now is that, okay, is this the end of the bear market? Yes or no? It's hard to tell. So let's see. And sometimes the market will touch the 200 period moving average and then kind of fall down again. It could do so. Now it's touching the 100 period moving average line, which again these the traders respect, and it just did a little bit of a consolidation there, nothing crazy, but it seems to be heading towards the 200. So yeah, if you were interested in the trade, so I did have a rule, like once upon a time I would avoid trading between the yellow and the purple line, or between the purple and the blue line, like if the market's rebounding. And sometimes I get tempted into still trading there, and the reason being that it's still a good opportunity. It's also risky because the market can just turn itself like on you anytime. So as long as you buy at a very good area of value, which is like the yellow line or the purple line close to those lines, I would avoid like stepping into those. Okay, so the market's here is touched the 200, and generally yes, it'll respect the 200 a lot. It won't just like pass through it. Yeah, it touched the 200, moved to the 20 period moving average line, touched the 50 period moving average line, and it seems to now kind of like now it's in the decision game. Like, what do I do next? Like, should I go high? It may just touch the 200 and pierce through it. That's one way it could react. If it pierces through it and goes up, a lot of the traders would start getting into the market. If it just bounces out of it and goes down, then that'll be like, oh, it's like still recession mode. So yeah, so I think the first candle closed, the second candle also closed above it, and that's going to create a lot of buy momentum. So yes, I would say that's a good time to get in. Now keep in mind, the market will turn soon and may touch the 200 PM moving average again. And that's just typical of like the markets, as I said, like it's turning direction. It won't just go directly up. It'll like take some time to align itself to this new direction that the market's offering, and see, it did that. Now it doesn't mean that it's going to fall down to like the negative, the low that we just saw. It's just going to like consolidate there, may touch the 50 period. It's still lower, so some traders will be like, oh, is it still back into the bear market territory? No, it's not. It usually will like respect these lines and then like kind of like decide on direction. So it's holding to the 50 period moving average line, and it will typically head up higher. Now the 50 period moving average line is an important one to hold on to get a direction of like, okay, what's in store for the market? Like, where exactly is the market heading into? Because it's holding on to it for support, and it seems to like head like in this area, or like it seems to like have broken it down, and so it did like go lower, and this is where a lot of traders were like, oh, I'm going to short the market's going to go down, and then it just kind of bounced back and be like, oh, sorry, I was fooling you. It's not actually a bear market. Because if it breaks through and this candle actually opened here and went down, then the people would have expected it to go all the way down there. So that's where it's hovering right now. And my gut instinct says that it would not just kind of plummet again like that, since it rebounded all the way to the 200 PM moving average line, and it's just hovering there. So it just needs some period to consolidate, step out of the like the recession mindset, and then move up higher again from there. So yeah, so let's see what's in store. It did break through the barrier of the 50 period moving average line, broke through the 200, and this time it should not like double top. There could be a tendency where some of the traders will be like, oh, it's time to double top. And this is a good indicator that, okay, it's going to push through, and like it should not double top. But let's see. Is it strong enough to break it or no? So some of the traders that would be trading this, people are like, oh, it's double top. And that's why you see the next one shot, like, people are shorting it because like, oh, it's going to be a double top. Is it going to fall down again? But no. So now it's going to try using the yellow as the guide rail, and now it's actually using the 10, and that's where it's been. So I would buy close to the 10. It's really actually tough to decide, but this would be a good area of value to buy. Yeah, so you buy your, and yeah, just like milk the profits and wait for it to, like, consolidate again. Don't just buy into strength, because your averages, if you bought one and you're scaling up, your averages would get affected by that. So don't do that. Like, wait for like perfect market timing, let it kind of like correct itself and then go in. And markets don't correct itself like when you want it to correct itself. It will correct it when it's ready to like do so. So you might be predicting like, oh, it's going to correct itself today, like recession's coming on today or this year. It'll take some time, because you got to give it perspective, because you're looking at a weekly time frame here, and that's how the markets would react too. So yeah, this is another good area to buy it at. So the markets bounces a couple times in the 10. It doesn't usually do that too many times. So somewhere you're like, if it crosses the 10, I would sell. And either if you sell it somewhere at the top, that's okay as well. But it's your preference. You can't just capture like the complete move from your to your. That's like it's rare. So you could do it maybe once or twice, but you can't just like eat the entire market up in profits. That's rare. So yeah, this is a good value to buy it at. The market again touched your, which is not typical because it's scaling down. Now the market broke up. The previous high was not as high as the previous 1 year, so there's not too much of like upward trend, and that's a bad sign. That means the market's kind of exhausted from this huge rally for just like a few months, and yeah, then it's a time to touch the purple line. So as you can see at the start, the market will respect the 10, then it'll touch the 20, respect the 20, and then it'll try to respect the 50. Then let me try to respect the 50 a few more times, and then it will touch the 200, and then we go into a recession. That's the market flow for you if you've understood something out of this. And the market's gone to the 200. So a lot of the traders would be like, oh my gosh, okay, is this another recession? And they'd be like, kind of like shorting the market here. So be careful, because if the market took a bull rally here, it's not typical that the market will like again go down and touch those limits. It's just consolidating itself at the 200, but it's below the 200, which is rare. You should usually do that above it. But anyways, if you've listened to anything that I've said so far, I would avoid, well, would you get it here? Yes, I would probably buy it here, but I would keep my stop loss somewhere around here. So as soon as it breaks this, I see this is not holding itself, I would have shorted that. Close my position here. This one I would not actually trade. I would not trade in the opposite direction. Wait for the market to kind of figure out what it's trying to do here. But I could probably buy. It's hard because again it's consolidating here, right? So like if you buy your got stopped out. If you buy so maybe in this candle would have been okay, but as you can see, it did another thing where it plummeted down. So yeah, it's a really tough trade. It's trading in a range. So another rule and that you could adopt, if you're not like an eager beaver that just wants to like get some momentum or money out of the market, what you could do is just avoid trading when the candles pass through these any particular stock. So what I mean by that is the candles should not pass through the 200, should not pass through the yellow, which is the 20, or should not pass through the 50. It should be clean, and that's where you should be getting in. So like this is a good strategy. This is a good strategy. Don't get involved when it's like like this. So that's something that will save you a lot of money. Avoid these range bound periods, because it's going to eat your profits, whatever you've probably earned in the past there. So again, avoid this period as well. So yeah, so the market's going up. Made a top here, moving down. So is this going to be a double top? No. It's not, it actually, and this is a good sign that says that no, it's not going to be a double top. And the reason being that it has so much of positive momentum on it. Now this doji here was kind of confusing because a lot of people would have sold their positions here thinking that, oh, it's actually, well, this is not a doji, it's a morning star. But yeah, it just went up a little more, and people would have thought this is a breakout trade, got up, and then like, you know, they got stopped down. But it's going to probably, well, again, this is a new trend, so it's respecting the 10 period moving average line, and then it's going to probably touch the 20 period. Is it going to hold through? No. Touch to the 50, and the markets would do that typically when there's a lot of strong, like it's just kind of propelling itself up for a long period of time. That's when the markets usually don't respect it. So yeah, like, you know, you may not know at a start, like, okay, should I be buying here? So you could have bought your and put a stop loss here, and yes, it may take you out. But if you look at the past, the markets did respect it, but it also did go smaller candles. Here it was just kind of, I think it was smaller, not too much, but yeah, it's still risky. So this was a good time frame to get in, but also, like, you know, there's too much of volatility. Don't do it in the first 2 weeks. Do it, wait for the third week, and then get in, and yeah, wait for it to like climb up again. And this may actually climb up more, because it's touching the 50 period and it's kind of like showing a trend, but it's also like really thick big candles. Another sign of like a good trend is, like, you know, you'll see the meat of the candles, or the body of the candles on the top, and that's a good positive sign. You can see usually it's always at the top. Yeah, made a new high. Some of the breakout traders would trade here. Would you trade here? I honestly don't like breakout trading, because by trading your, like, or like, you know, trading, this was a previous breakout was your, you would have lost money and you missed so much of the trade. So I would not, I honestly don't believe in breakout trading. I would believe in like value trading near the, like, you know, good areas. And I used to be a breakout trader, and like, you know, to me it was like, doesn't make sense why I would. Sometimes you need to, like, you know, get in through a breakout, but if the breakout is close to the 50 period moving average line, that is the time. So yeah, so it's going, touching the 50 period moving average line here. I would buy here. I'd say, like, yeah, this is a good value to buy it at. Keep an eye out if it may just turn here, but if it doesn't, yeah, it's a good time to buy. And it's strange that the market's, like, you know, kind of bouncing around the 50 period moving average line so much. Because normally, if it's a good, strong, steady trend, the 20 period moving average line is good enough for the market to, like, support itself. So it seems to be funny. This may actually cause some volatility or like range bound efforts in the market. Okay, so it's broken it, gone higher, doing well, made another new high. So you know, you buying in these areas, see the amount of profit you would have made. Now, yes, you would have your, you know, you would have probably made a mistake at this, but buying in these areas. So some people say, even if you buy between the 20 and the 50, just time it somewhere between, that's good enough, because the profits come out after the 20. So yeah, good upward direction, made a new high. It's a 1556 level. Wow, really strong positive direction. Markets are making good positive momentum. 1587, wow, this is like a new high in 2013. There's a period of consolidation there, but it's holding on. So now the market's respecting the 10 period again. And that's a sign that is a strong uptrend if it respects the 10 period. But it usually does that only for a couple times with the consolidations, and then it's like, oh, too much. Let's see if it's holding it on, or it's going to come to the 20. It cannot sustain it for too long. So unless it's a super long bull trend, no. So it didn't sustain it, came back to the 20. Now it's hard to tell. I would not possibly be able to tell, is it going to hold on? It seems to be a decent trend, but you know, I would still go ahead at the 20, rather get it at a good price, rather than, and like, you know, risk a small loss rather than waiting for it to just nosedive to the 50, which it may or may not. In the previous instances they did, but you can't always guarantee it. Yeah, so the market's still heading higher, heading higher. Now this second high, which is not too high compared to the previous, is a sign of fatigue. Touch the 20 again so close. So that means there's some fatigue here, and it may just kind of like take a breather and come down to the 50. Let's see if it's true or no. It has enough strength. Again, I would buy your, and not even look at the markets as it's like, you know, don't ever think about buying it all the way up here, anywhere in this range. So touch it again on a daily time frame basis. Again, I would say this would be good enough to get into as well. So it's making small incremental highs now. It's not those huge gains. So the huge gains, and it's also, I guess, because that it's respecting the 20 period so much more now. So another important note, the markets usually go up for 5 to 7 days in a row before it actually starts consolidating. So another thing, note it down. So you can see 1, 2, 3, 4, 5, 6, 7, 8, but it's like really small dojis. 1, 2, 3, 4 days. It can be longer if it's like actually small candles, but if it's big candles, 4 or 5 days is the max. 7 is rare if it's a really strong bull market. Smaller candles can take a little bit more. So yeah, I think it's touching it's going to touch the yellow. And another thing would be like, okay, it respected the 20 period for a while, touched the yellow, okay, touched the 10, and now it's touching the 20. So like, how much strength does it have in it? Can it go up more? Is this going to be a more extended bull rally? It's going to the 1800 levels, which is like a all-time high for the S&P. So yeah, let's see if it has the strength to pull it up. And it's like, you know, don't kind of like predict, okay, it's gonna fall down now. It will or may. Use the predictions to kind of guide you into what's the right time to buy and sell. But in terms of like, you know, you should be a trend follower, not a trend predictor. So if the market's falling down, don't predict that it's only going to go down so much. Or if it's going up, don't predict that the market's going to go up. Like, have a consensus or have your intuition like guide you, but don't just let the market you don't kind of predict where the market's going. So see, it actually respected this 20 again, and it's moved again higher. So again, good strong points to buy that. Although these points come after long periods of time, this could have been like December 2012, June 2013. So it's a long period of time before you get another buying opportunity. Now, if you look into the daily time frames, yes, you could have bought your, and that would be the 20 period moving average line on the daily time frame, and that's healthy enough. If you want to like just hop into the market a little more often as well. You can do that as well. But again, keep an eye on this overall trend. Weekly is important. So it's back again to the yellow 20 period moving average line. Seems to have respected it again and made a new high. Now, after a certain point of time, like the market may decide to take a break and touch the 50 period moving average line because it may be just a little bit overexhausted. It's doing it by touching the 20, but this kind of like just indicates that this is a strong bull trend that we are witnessing here. So it's touching the 20, touching. And now, yes, see, that's exactly what I was indicating, that it's going to touch the 50 because it's been a strong rally up forever. And again, this would be another good buying opportunity. You'd be like, why Sheldon? Like, why buy here? It's like, wouldn't it come to the 200? How do you know it's going to just stop here? It could actually like say, okay, it's done too much, but it won't just like nose dive to the 200 directly. It'll come here, it may just touch the 20, and like, we just kind of saw that how that truck turns because it's like a huge, this would be like a multi-year truck if you would call it. I would say 100-wheel truck. So it did make a new high, and now it's trying to kind of see, okay, can I hold on to the 20 period moving average line? Not so much in terms of like the new high, just made a new high and then it's heading lower. And yeah, that could mean like it's kind of tired. It's like, how much more can I go up higher? But I would personally buy your, sell it somewhere around this area here as soon as it broke down a certain level that either the 5 or something like that, and then wait for the next buy somewhere your, if it respects it, sell it your, buy again your, and sometimes if you get a good enough price, you can even buy it at the low here, and that's good as well. And then this is like an exhaustion sign. It's showing you that it's actually a little bit exhausted because it's not as clean as it was before, but also this would be something you would see or identify at the end of a rally. So I don't know if it means that, okay, it's the end of a big period of gains and it may just kind of like go down. It's still 2100. Now, if I look at today's market, the S&P futures at its high peak ended at 4,800, if I believe I'm right. Yep. So it's still a long way to go. So don't feel afraid that there is not enough upward momentum. It may just kind of like keep heading higher from here. While it actually heads higher, I'm just gonna give you a small like a book that I read about investing in the S&P ETFs or like the S&P futures or any of these markets, and it talked about if you were an investor during this period. Okay, I'm just gonna zoom out to show you who it's a huge bull run period. So say you were an investor from say anywhere between 2010 all the way till like 2015 over a 5-year period. You would have made a lot significant money. Whatever you invested in, you put it into stocks, you put it into like ETFs, S&P 500. Now stocks may be a little dicey because it depends on the performance of the companies. They can go up and down, but the S&P 500 is holds the top 500 companies, and it has a cleaning mechanism in which if the company doesn't do well, they will automatically take the company out. That company doesn't actually meet its standards to. I'm just going to pause while I complete the story. Meet its requirements to still qualify to be on the S&P 500. So you basically have the S&P 500 is possibly like your portfolio manager that will clean the stocks up for you, put in new stocks, to get rid of the bad stocks, and do that all like for free. And that's a really like good way on how you could like handle or trade the stock market. Is so if you're investing like any points of times, you would actually put the money in the dips, put the money in the dips, put the money in the dips. You would have made a fortune in this period of time. So basically, there were books that came out which were talking about like, you know, the amount of money you could make by just investing into the S&P 500, but their investment time was only in this big massive bull rally. However, if you were to put your money around in this point in time, you would have like lost a lot of money out of it. So you know, so it depends. Again, market timing is important. I don't discount that. It's important to time the market. So back to where we were. So we, you know, as I said, like there's fatigue in the market, and that's what you're seeing here. It's a sign of fatigue. This consolidation that you see here is that the market's like, okay, I need to really take a break and go down to a level that I feel comfortable with. I'm too high right now. So that's what it did. It came here. It kind of like did your, but it bounced back up. So, you know, this is where it did it. So as I said, like you could have bought it over here somewhere around the yellow line, rode it to the top of the line, and then like you can wait it'll come down. It's really risky, but buying anything on the top here would have like, you know, killed you. Not killed you, but you know what I mean. Would have you know, caused you to get into a loss. So yeah, buy closer to the lines. Now some of you might have bought your and be like, okay, you know, you still made a profit, but once this happened, you saw such a strong like downward candle, it means like it's a change in direction. So another note to keep: if it's a strong downward candle, like a big one, it means it's a change in direction. So let's see what's in store. Is it going to hold on to this line, or it's going to bounce back up? Most likely it may end towards the 200 just to kind of get a breather, or sometimes it'll be like, you know, just how it kind of was bouncing around the 20 and then it bounced around the 50. It may just bounce around the 100, but not really. I would say 100's not as well respected. It is, but not as well respected. So let's see what's in store. So it's hovering around the 100, and they're like, oh, 100's a new holy grail, and they're like, nope, it's going down. This one's a new candle. It did change direction though, like flipped on it, like, you know. So always wait for the candles to close before you decide. Yeah, so it held on to the 100. Interesting. And again, like, you know, it's not me. You know, me just trying to predict where it's going to hold. It's you just kind of like taking a bias based on how it's reacted in the past. That's trend following, not trend predicting. So it came down here, held on to its ground over this level, and then bounced back up. So that's the way it has been, and now it's come out of it. Now if it came out of it, it may just like, you know, touch the 50 period moving average again, or it may just continue going up. We don't know. Let's find out. And so the market heads up higher into the positive territory, getting over the 50 period moving average line. Now, this is expected, where the market would go up, pierce through the 50 period, and then kind of touch it again. And it could possibly consolidate, or it could possibly go higher. So in this case, it's consolidating. This was a little tricky consolidation because it bounced down, bounced up, kind of like, you know, oscillated in no man's land, and then again went down. It's hard to tell. Is this going to be the top where it just doesn't have enough of momentum to take it over ahead, or to, like, you know, continue this upward bull run? So it seems to have headed over to the 200 period moving average line. So I guess what's happening here is the market went up into a huge bull rally, consolidated, broke through the 50 period moving average line, started to try to go above it again, like so, without even touching the 200 period moving average line. And this is what the market does. It never just pierces it and goes straight to the 200. It would sometimes on rare occasions, but if the gap is so thick, it needs to just kind of oscillate. Now, typically, it would just touch the 50 moving average line and then go down below. In this case, it did not. It actually went above it, hovered on it, and then touched the 200 period moving average line. So just some lessons to learn. Markets don't always touch it, like, you know, like how we talked about the tractor trailer turning. It'll sometimes do it the other way around too. And yeah, so yeah, this one, it touched the 200 period moving average line. Now it's gone higher. So that's another expectation, is where, like, you know, if it breaks through the 50, it has to go closer to the 200. Now, you probably would be wondering, like, why did it not actually stay around the 200 moving average enough? And it should have, because, like, you know, it's a very significant line, but I guess the market was so hot or bullish that it was expecting it to just like bounce out of it and like again go up into a new high. Now this was also tricky, because if you bought it was good, but it just went up and then again bounced down, again tried to go up, went to the previous high, which it, you know, that's the previous high, so it has to go there. Bounced on the 20, moved up again. So this is becoming a strong resistance, but something that it actually did break through. So that's good to see, is the market almost avoided a bear market in 2016. So made a new high. And if it makes a new high, that's like, you know, really good signs that it's like heading up higher from here. So we let the market move further up. It seems to be doing well in terms of, like, you know, having good positive direction on it. Let me see how higher it could go. And so usually when the market starts trending higher, it will either try to form a direction. So seems to be like it's trying to decide on, okay, what is my support and resistance points? How bullish would this trend be? And that's kind of something that it's trying to decide now. So it's taken some support on the 20 period moving average line, and it's going to try deciding what to do next from there. So we let it play around and see what happens next. And yeah, it's made a new high. Now this is an interesting move. So it actually did drop down to the 100 period moving average line on an intraday basis. So it's a fairly steep drop by any sense of imagination. So, you know, you'd probably take it here, make 3 weeks of profit, see it go down again, and it's really tough, honestly speaking, to like trade these kind of small moves. So it held on to the 50 period moving average line and then made a new high. So yeah, it is tough, honestly. Like, you know, you would probably close your position around here. You know, you try to, but it's not a trend. So I would say keep that in mind. It's only when you have a trend defined and it seems to respect the previous moving average line, that's when you should decide to buy on it. It did try to respect it, but could not move to such a lower point and then moved higher. And now it's like it's playing Superman now and trying to get to higher highs from here. So yeah, this is a brand new high. It's heading into a really new territory at that time. 2351 to the 2350 levels was not heard of. it looks different looking back in retrospect, but this was, yeah, new highs back then. So now it's since it's done its previous ramp up, it's now trying to touch the 20 period. It didn't really touch it, which is interesting. It normally doesn't really like hover in midair, but I think this is the beginning of a new bull run, I'm guessing. That's why it's just trying to touch. It's been so aggressive. If I zoom in into it, it's kept on to the 2 period moving average line. Here I touched the 10 period moving average line. You pierced through, didn't even like, it's so strong, it's so hot that it's not even respecting the 20 or the 10 as well. So I'm gonna let it run further up. So if you were late into the market and you were not able to decipher what this was, the best points would be trying to find the lowest low and then getting into it. Like again, close the market here, close your trade here, get into the lowest low, see where it's gonna kick back up again, and then get into the market. So anything closer to the 20 or the 10 would have been a good indication to get in. You could have gotten even like your, and it would still get you some profits. Your again would be a good value. Now you see it's trying to make consolidate to the 20 because it has had like at the start, remember we talked about it, it's the 10s and then it goes to the 20s and it's going now higher from there. And yeah, so I think that's I think the strategy is very simple. Get it closer to the baselines, and yeah, that should kind of save you some grief. So yeah, keep it up, keeps running higher. So just buy the dips and sell the highs, and that's the strategy in trending markets. And yeah, keep running it higher. And in these kind of bull markets, the markets really trend or move upwards really strongly once they've determined that this is a market. So this could be, so say for example, the market started trending higher in December of 2016 and it's 2018 and it's still still kind of skyrocketing upwards. And it usually does that pretty often, where it won't really rest until there is some kind of a bad news or a bad sentiment that comes in. But this is also heading into an overextended territory. So you see a small drop here, and I'm just going to pause and talk about it. So the market actually took a big downtrend. Well, it's not a downtrend, it's just corrected itself because it went into such a strong bull rally. As I said before, if you remember, if there's too many strong, solid, big candles, full candles, and the bigger the candle, the more chances of it falling down. So yeah, so this is where it kind of went up. If you were to really time the market and start shorting the market here, well, I wouldn't say short, but yeah, it would, even if you were to buy your, sell your, you'd have made a decent amount of profits. So something to keep in mind. And also something that I personally have learned and regret at times as well is that you might, I'm just going back in time, but you might just get kind of stuck into this, get a few losses here and be like, I just don't want to trade anymore, the markets don't work for me, I can't understand the markets. And it's common and typical for someone to just shy away from it because of these losses that have come here. And the other thing to keep in mind is that just don't get discouraged when those losses come about, because if you stopped trading, these small losses, however they were part of the game, would balance itself out when you had such a good strong gain from like 2017 or 2016 all the way to 2018. It's like 2 years of gains. So that's something you would have missed if you were not invested into the market when it actually happened. So something to keep in mind. So let's see what happens next. We're going to just wait and see. Is the market going to recover? It touched the purple line, so that would have been a good time to get in, but it's not guaranteed. So, and the reason why I say purple line is good because it just respected it a few times before, but it was so intraday, so the market may just either like, oh, I can't, this is not good enough for a correction, I need to correct more, touch it and then come up, or it might just be like, oh, okay, that's enough. So just keep it in mind. Yeah, so we're going to just wait. See, it did consolidate to the purple line, which is the 50 period moving average. Yeah, so we'll just wait. Yeah, so we just wait for it to finish its consolidation and then decide on where it has to go next. So I think it's deciding to peak up again. It's consolidated. Yes, if this was me, I would try to figure out on a daily time frame where could I get it closer to this purple line, and then just have a trading stop loss and wait for it to see how much gains you can get, and then just kind of ride it on the upside. So yeah, it's making good highs. It's almost touching to the peak. And it's also almost touching and making like a new high now. So it didn't actually touch it and make a double bottom, and that would be a sign of like weakness. But this is the area to keep an eye on, because sometimes the market will touch this and just kind of bounce back down. And we saw in previous instances where it went on top and then it kind of went down there too. So just pay close attention. Sometimes it would be fake tops, but if it's consistently moving higher, then it may be like, oh, speaking of the devil, and yes, it actually just formed a double bottom. But I want to just like talk to you about this. So this is the double bottom line, 3874. Where did it actually form? The 3930. So you would be thinking, hey, this is not a double bottom, this is a breakout trade, and I want to get in here. So my advice to you is, buy your, but avoid these breakout trades unless it's actually consistently, either it's gone up and again it'll kind of like took a breather on the breakout trades. So that's my advice, because I've seen it often of not, at least this is the second time where it may just kind of slide through above it and then just kind of bang hit it again. So that's my advice. Let's go ahead and see what's in store. So oh yeah, it did correct itself a little lower this time. This has gone below the 50 period moving average line, touched the 100 this time, which it also did on a daily basis. Now the question is, something to talk to you about. So it almost touched the 100, but what it's doing here is, remember the tractor trailer turning, it is turning below the 20 period moving average line, and then it'll turn below the 50 period moving average line. I'm not saying that's going to happen. I do not know, but anticipate the change in direction, or at least what it seems to be like it. So it could even pierce through it, go up and make a new high, but just a little bit of caution to this as the change in direction comes about. So yeah, it's making new lows now. It used the 20p moving average line as the direction to like head lower, touched the 200p moving average line, which is a fairly, like, I would say, low period for the market. And yeah, so it's touched the 2018, the 2019 now. So the end of 2018 is where it actually touched the 200, and people would call it like the New Year rally, not the Christmas rally, but the New Year market. And it's kind of like gone up from there. And the reason why is probably also because you see the 200, it touched it and bounced back up. So people would be expecting that, hey, this is also in touching the 200. So yeah, if you were a trader and you wanted to bet on a market, not bet, but kind of like time the market, buying somewhere around this level would have been ideal because you would have really milked it. So yeah, something to consider. And yeah, you could then let it run, see how much higher would it take. I would buy it somewhere, like if I was scaling up, like say you bought it somewhere here and you made a decent amount of profit, I would like try to buy somewhere here or somewhere here, like somewhere in like, when it's kind of like resting a bit, and then go, now this is going to be another double top. I don't think it should be. And the reason, well, it did consider it to be a double top, unfortunately. So my reasoning was that, like, because it's actually done it twice, the third time, like, it may just kind of like avoid having a triple top. Like, it's rare for these triple tops to form. However, it's been more accurate in it this time in actually saying or provide. I'm going to let it go up and see what's happening next. So it did form a double bottom here, which was not typical, but because it took such a big drop, maybe that's why, or it's just trying to consolidate now because it just went above the 50, did not really take a breather. Now it took a breather, now it's going to go higher. So yeah, little different side of instances and how it's actually reacting. But I don't think we have seen an instance where, so see in the past, it touched the, let me just compare this because this is a good lesson in terms of what does the market do when it touches the 200 period. So it touched the 200 here, touched the 200 here, went up higher, almost to the top here, same as this, went again to the 20 because the 20 was on it at that time. Moved up higher, again touched the 50, and then went up higher. So it's same thing here, touched the 200, went up higher, consolidated, didn't touch the 20 like it did this time, then touched the 50, and from the 50 onwards it went higher. So as soon as it touched the 50, that's when it went higher. So it seems to be parallel. I did not catch this as well when I first looked at it, but I hope it makes sense to you now. Is that when you expect it to drop, so if you are taking notes down, please make a note that if you see a market touch the 200, don't expect it to just go directly and make an all-time new high. It will make a high or go touch the previous high and then consolidate or then correct itself to the 20 and the 50. And from the 50, it will then bounce to a new high. So make a note, take some time. Don't just skip that because it'll help you when you actually face this scenario. Now, you don't have to just keep going to your notes all the time as well, because you can just go back into history. But you should remember, okay, this is what happened in this year. This is what happened in this year. And that's what makes seasoned traders so great. Is because they remember exactly what caused these kind of confusions in their trading journey. Now, if you were to, what we're doing in this particular exercise is expediting it for all of us, because now we don't have to just wait until we get that experience in the market. We are actually getting the same amount of experience as these old traders by going through all that they've gone through to in real-time trading markets. We're also blessed with having these trading platforms where we could look into the past and get an idea of like, okay, what exactly is happening here in the market. A lot of these old-time traders did not have that. I remember in the old days too, I would sit down and actually like go ahead and like search the market for data. And I would try to find like Yahoo Finance would give me a little bit of data. In the old days, people would get it from newspapers and try to build their own charts, and that's how tough or difficult it was to really analyze the markets. And they would have to draw it, sketch it out, and like try to predict, okay, what's happening to the market. And it would be a real exercise to track a particular stock, and now it's like available for free. So we're really blessed, to have that available at our disposal. So yeah, let's continue. Just things to like kind of ponder on and like what the benefits were. Okay, so it's making another new high. We let it play out, and it touched the 50 again. And now it's like retracting. This is a really and normally if it does this, it usually comes back again. Let's see if it does, or it's just content with the 20. No, it is touching the 50. So this is again a theory that we've proved right, is that if it just bounces one, it's good to kind of short the market again, because it's going to like again make sure it touches the 50. So these were two closed quick 50 touches. Not sure why the market's doing that. I think it's just trying to still find or figure out its base, or is it like too overextended? It seems to be like trotting around in that territory, and we're going to head closer to the 200 the March 2020 crash. So that's coming very soon too. So I'm wondering, is this because of like so the market made a new high here, but soon you'll see like bad news from like COVID and all of that coming up. I wonder how much of that would take a toll on like the entire market. When do you see the declines? But this is a market making a new all-time high. So there's a lot of positive sentiment here. The market's just like 3,134. A really good level for the market. This is December 2019. Market's doing pretty well, and it's made a new high. It's just skyrocketing again, and everything's looking good. Now we're looking back. We're like, oh, like there's going to be a big crash coming, and I wonder if this is where it starts. Jan is, I think, when China or something had some news. I don't think it's still affecting the market. Feb, again, market's making a new high. Feb 17, third week of Feb, and oh yeah, and this is where this is where it started. So Feb, second week of Feb. So the market took a nice, good, positive run up, touched to the second week of Feb, and that's where it started heading down. So 17th Feb onwards, 2020 is when we've seen like the crash. Now, anyone that was trading would have not predicted that this bull run would like kind of change direction so instantly, but that's what happened, and that's like an external circumstance that caused it to happen. So yeah, just to be mindful, as I said, like you would have been on vacation somewhere and come home and you'd be like, oh, the market just crashed terribly. So stop losses, if you had a stop loss here, you would have been safe. And then once you see it actually breaking down, like you could then like short the market. But no one was predicting it would fall that much. So yeah, we in retrospect know it was a big fall. So yeah, so it actually it tried to bounce back up. It went, touched the 200, went lower. I'm just gonna go zoom out so you can see the real plummet. This is one of the biggest plummets we've seen. Now I haven't gone back in history and looked at the 2020 crash, sorry, the 1920 crash, but that's something I'm going to do in another video, and that's going to be a big video because we're going to look all the way from the 1800s to the 2022. So that's going to be a really big marathon video, but it's going to give you so much of insights into how the markets reacted, what's happened there. So yeah, this is 2020, the big crash that you've seen there. I just want to pause and kind of talk to you what's happening here. So the market took a plummet down, broke through the 200 period moving average line, and that's rare. Markets usually hold on to the 200, as you see. I'm just going to zoom out again. It just held on to the 200 so many times. So that's something that a lot of the traders expected. So when it took a crash down, that was like new, like the market's never done that. So it went down, and this is the 350 or the 400 moving average line. I think it's a 300 moving average line. Sorry, 450, I'm right, 450. So this was the 200, 250, 300, 350, 400, 450. So it actually, we don't really need these lines. Honestly, you don't need to put all of these moving average lines on your trading charts as well. It's just something that I use as guide rails to see, okay, how much is it going down. Some people put grid lines. This is my grid lines, but my grid lines are actually in the direction of the market. So yeah, it actually did plummet so much. Went down to, so it went down from the 3376 levels to the 2100. So 3321, almost over 1,000 points. Now 1,000 points in relative to being 3,000 is a lot. So that's like 25%, if I got the math right. But it's a lot. You can see it's a big drop. If you look on the grand scale of things, yeah, it is a big drop. You know, so how the market's like fallen, similar to the 2008-9 crash. Similar to that, it did fall a lot. And what it did after that is that it did not bounce back on the 200 and then turn down further. It said, okay, that's enough, let's go up again, and now it's gone. It touched the 50 period moving average line, and now the question is it going to, you know, do the same like the tractor trailer turning direction and like moving up lower? That's what we've seen it do in the past. So if I show you the two, this is the 2008 crash, you'll notice that, okay, it actually, where did it do it? Oh, so it did it over here. This is at the start. It actually turned, went down, touched the 20 and went down. But this was, I think, a little more different because it actually did not turn direction so slowly. It just went plummeted to the bottom. So the question now is it going to hold to the 50, or is it going to break it and then make a new high? So if you've looked at the charts, you probably know, yeah, it's probably going to make a new high. But let's see the journey as it does so. So yeah, it's made its new high, and like it's really hard for the traders to like pick this bottom. But if you did, you would have been really you know, good. A lot of the traders like, you know, stepped into Bitcoin in this time and era, and I think a lot of them made a lot of money in that trading Bitcoin as well. So yeah, the markets now like took a base on the 50 and now it's heading higher. So yeah, if you could have bought this at the 50 level, 50 moving average level. Some of the traders would be like, okay, it broke over the 200, I'm gonna buy yours. So you buy low and then you would have just ridden the profits up. And now you will see is an amazing bull run fed from the reserves of all the banks that were providing stimulus checks, and like a lot of these kind of just keeping the economy running, not just stagnating it. And you now notice and witness an artificial bull run fueled by the banks and by all the not the banks, actually the government. So the banks also did get a lot of money out of it. So that's what you're seeing right now. Now it did have a small correction, and that's what you're seeing here. Now let's see how much where does it touch? Does it touch the 20 period on a daily time frame level? Now generally, as I said, it would normally touch it, kind of like ruminate on it. Okay, I'm at the 20 level, that's enough for me. But this one's like heading higher. So if this was me, I would have bought around here, rode it to the top, and maybe close my position around here. Bought it again here, rode the top, not to the top, but and then again, if it falls down, maybe I would have put my short sell here, and not short sell, my stop loss here, and it would have kind of triggered it. Come back again here, and then rid it up. So this is a little weird one, because it kind of does something very similar to a double top, but it's still oscillating, trying to figure out, okay, is it actually the end of the run? This is where we had a few more lockdown periods as well. But yeah, the market's very positive, heading up higher. And it's made its new high. So 3740. And it's made a new high. So the market's doing pretty good. It's trading or trending on new highs day after day, week after week. And what you are now going to witness, and this is because we're so close to this year, we know how it spanned out. But in terms of just kind of simulating, this is your first time seeing it, you should actually be buying closer to the 20 periods or even the 10 periods. You won't get too many opportunities when the market's really strong in a bull run. So even if you get it near the 10 periods, that's good enough. You can just ride it through, but avoid getting stopped out. The ideal periods would be here, but holding on to this, because it's just too range bound, though it's trending higher, to really prevent you from getting stopped out from all these trades. So the market's gone to the 4,200 levels, now consolidating again. And this is actually a big run up. This is a big rally that the market's experienced, where it took a big dive up and then it kind of went range bound a little, and now it's so if it does this is a period of exhaustion or consolidation because of the huge rally up. However, saying that, it did still not have enough of downturn, I guess enough of correction to touch even the 20 period moving average. It's still making new highs. This is also when Donald Trump was the president of the United States. I'm not going to get political in this and tell you if it actually assisted with the run up, but it's more because of the stimulus provided. There were a lot of people sitting on money that they did not know what to do, and they were investing it into the market, and the market was giving it to them and compounding their returns. And more people were investing. There are a lot of extra money coming in, and you can see the big rally up from there. And yeah, so this is the first correction now. I think this was one. The second, so your question may be should I just wait until the market closes at this 20 period moving average line? Yes, in the bull runs, you could keep your stop loss below, because you could still, if you had kept your stop loss, so basically if you had to buy here and say I'm going to buy it at the yellow line, I'm going to sell it at the yellow line too, you'd have actually got the entire rally. If you were closing it up at the 10 period moving average line, you would have got stopped out so many times. So that's something to keep in mind as well, and say, okay, if it only closes below the 20 period, and you can only do that in really strong markets, bull markets, not any market. So thing to keep in mind as well is that it doesn't really work in any market, only in strong bull markets, because otherwise you might just get, you know, kind of like chopped out through like range bound markets and things like that. So again, it touched it one more time. So is it consolidating itself? We are at the 4600 with December 2021. So this is almost to the end of the today's date actually. So we're going to head into the 2022 very soon, and this is where the market peaked. So to talk to you a little bit about it, so yeah, you could have bought at the yellow line, but there's such a big period in between. You'll be like, you know, what do I do if I don't get another opportunity? Yes, you could still buy, but buy it closer to the 10 period moving average line. I would not recommend going any higher. So if you see the 5 period moving average line, no, that's not a price that you should be buying it at. And the reason being that the 5 period moving average line is not safe enough for you to buy it, because it would just like, you know, cause you to get into a loss. I personally did that. I bought it close to the 5 period moving average line, and you know, it's a lesson that I've learned not to do it ever again. So again, if you're looking for better opportunities, look into the day time frame. You would see a day or two, like, you know, where you would get this opportunities to buy closer to like better lines. So yeah, the market's gone up, and now it's just kind of consolidating. Now it did make a new high, which was, it touched the 4813 mark. Now usually, so this is the 4546 4648. Usually the markets don't really respect milestones. If this is 5,000, yes, the market correcting itself at 5,000 would make sense. But if the market is just kind of touched the 4,800 and moved down, it is also, yes, it's a multi-year from like bull rally since the pandemic up there. So the question is like, okay, is the market going to correct itself? How much is it going to correct itself? And where is it going to like find its bottom? So let's see what's in store. So this is Jan 2022, not the Santa Claus rally or the New Year rally that you would expect. Well, it was a Santa Claus rally, but then the New Year kind of brought it down. So people would be thinking about, okay, is this a good time to buy? I'm going to buy your. Me too. I was so inclined. I did buy it at this level thinking, okay, this is going to go up. And I bought it here, but this is where the tractor trailer changes direction. Remember we talked about this, where it touches the 20, but if it doesn't go, sorry, it touches the 50 and it doesn't go above the 20 and then moves down, that's a bad sign. So I personally bought here as well thinking, okay, this is, you know, a sign that the market's going to head higher. I've seen it done it so many times in the past, like it touched here, and it went higher. It's in a strong bull rally, but yeah, this is just a small correction, not going to be too low, and it's going to go higher. But then the tractor trailer started to turn its wheels. It's turning its wheels. And that's something that caught me off guard. But something, you know, in retrospect, I would never do again, is because I now know that this 20 is important to see. So people that would short here, but it's too hard of a bull market to short, but people could have shorted here and then see it going to the 50 again. And now let's see where it's heading. So yeah, it touched the 50, it's bouncing up. Okay, now it's making a new, not a high, but it just kind of like, you know, stabilized itself from the 50, moving up higher here. So yeah, let's see what's happening. It did not or could not hold on to this particular range. Now I just want to compare this to the past, because this is good insight. So if you notice here, and I have to excuse me if you're on a small screen. I do apologize. I'm trying to show you perspectives on the same plane. So if you look here, and you might have to, I don't know how you'd zoom in. I can, but I need to also show you this. So that's the reason why I'm keeping both together. So if I look into this downturn, you will notice that it touched the 20 and then turned direction, went lower, it bounced back, touched the 50 and then went lower again, and then touched the 20 and moved lower again, then touched, and then it kind of came out of it. So similarly here, it touched the 20, went lower, touched went through the 50, but it's kind of like still turning its wheel, so it doesn't just turn in one go. So that's what I was trying to point you at. So it's kind of went above it a little. So this was actually like, people would be like, oh, it's actually going to head higher and make a new high. I thought so too, but no, it's actually like turning its wheels and then made a low. So it's now around the 4,000 levels, heading lower. And so if you were, even though you timed this wrong, I just want to show this to you. If you were someone that actually bought, so the way you could trade this is, now in retrospect or hindsight, yes, but this is how you would trade it. But you would wait for it to close below this, wait for it to go here, say, okay, is it actually going to go up higher? Is this the end? You see it turning here. This is like a guardrail to be like, okay, I want to short the market. And some people would be more conservative, and I would agree with it. If you're not that risk averse and you want to just kind of stay away, you could just avoid trading this particular downtrend as well. But this is some place that you could hold a shot at, get it up to here, and then you'd have to close positions because your stop loss would have got triggered. Your trading stop loss would got triggered here. Then it comes back up again, takes another U-turn, and then heads lower. And this time it actually takes another turn. But this was interesting to me as well. So it did go close above the 20 period moving average line and was heading here, and everyone was like, okay, it's another rally, and then it formed a doji. So this doji is something that is a very good indicator that the market is changing direction. And we've seen a few dojis. It doesn't always come up, but we do see a lot of dojis in this journey that we've gone through from a couple of decades. And so this is another point where I would consider, what should I do next? Now, I would not short the market here. I would not short the market here. I would not short the market here because the market may just like, okay, I need to just kind of relax another bit on this 50 period moving average line. Now, as soon as it kind of like sees it going down here, or maybe around this level, is where you could be like, okay, I think I am ready to start shorting the market. Now, it depends. Again, your risk appetite, you could have done your, this is too risky, honestly. This was not the right time because it's still in like a bull consolidation phase, and this is where it's turning. So yeah, somewhere around here, the 4,200 mark could have been a good entry point. So it did, and then you could have like waited for it to close. Whatever is your trading strategy to close, you could have. Yeah. So let's see what's happening next. It did take a big nosedive. It tried touching the 10 period moving average line and then went down. So it touched the 200, which is the 3615 level, a very strong level. And normally or typically the markets tend to just consolidate around the 200 moving average level because it's so strong and it's like got a lot of support on it. Some traders would have probably bought at this level and kind of ride it to the top. Now, an important thing is that would it break through the 50 or would it then just turn direction? So if you remember, we talked about, I apologize again for making it so small for you. You can see like, over here, it actually touched the 50 and then went down, touched the 20 and then went down. So that's what I'm trying to look for over here, is that, okay, is it going to touch the 50 and then move down again? Or is it going to just kind of like pass through it and make a new high? So that's something that I'm looking for. So let's see what happens here. Does it actually hold on to the 50? So it seems to have gone up and broken through it. And no, it actually went through it and then started consolidating. So that's a risky move. So similar to this, where it just went on top and went down, that's what it did here. So it went back down again, so it's still going lower. And now your question would be like, okay, I'm going to short this over here because yeah, it actually, you know, broke. It didn't actually give me a positive sign, give me a negative sign. So could I have shorted here? So this is the point that I would have probably got in. And this would have been a little tough because the market, again, doesn't just go as a W. Like, you know, it just doesn't go like this, or like goes from like the 20 to the 200 to the 20. So that's generally how it goes. But if there's a big gap in between, you'll see like, okay, it tries to take a break in between before just going down. The market is an old man. It's been around for like over 200 years, so it doesn't have that much of like, you know, I'm just going to leap to like 10,000 S&P 500. It doesn't do that. So it's taking a direction. So it's consolidated here, moved up, and now like your expectation would be, and mine was as well at that time, was that, okay, I wanted to just go back again to the 200. It didn't do it instantly. It took a breather, went and touched the 20 again, because it, you know, usually likes to surround itself with all the moving average lines. That's the mean reversion. So it did that, touched the 50 on an intraday basis, on a daily time frame basis, and then touched the 200. And now since then, it has started to go below the 200 period moving average line. It's just trying to hover on it and see, okay, is the 200 going to protect me? Yes or no? Yes or no? So it's trying to consolidate itself on the 200 and like, you know, just kind of figure out like, okay, what is the market going to do to me? I'm at the 200 level. This is like my bottom. So, and this is where we are actually today as well. So there's no more to take you through. But if you're looking at the market right now at this level, you know, your question would be, Sheldon, what is the market telling us? Or like, you know, or you kind of like give your insights as well from, you know, what we've gone through the past. So the market's touched this, moved up here, touched the 50 period moving average. It's kind of like hovered itself here. Now the 200 is going to play a strong part in supporting the market. Now this could also be considered to be a double bottom, but we've kind of seen instances where it doesn't really show you a double bottom, but the 200 is still holding through. It could possibly just break through this and touch. So my gut or my theory is that the market may touch closer to the 20 period moving average line and then decide, okay, I need to go down further or go up. So I would say the 20 period moving average line is something that we could expect the market to head towards. And that's because of how the markets reacted to like the previous, like the changes in direction. So it touched the 200, moved up to the 20, broke the 20, went to the 50, turned down, touched the 50 again, turned down to the 200. So it could possibly touch the 20 and then head down further. That's possible. But the 200 is going to play a strong role here. So something to keep in mind as we move into the next phase of the market. Is there a bull run coming soon? Maybe, if the 200 holds strong. So you can see the 200 held strong in 2018. Also in 2008, you saw like let me just go and refresh my memory. Did the 200 hold strong in 2008? No, it did actually break below the 200 and then kind of recovered, but it was a multi-year recovery phase to get out of it. So in this case, the market has already given up its gains. So right now it's the same level as October 2020. So it's given up a lot to donated back to the I guess whatever the government provided, and every inflation's kind of eating into a lot of the profits. So the question is it going to go down further? It all matters. It all depends on like how is the market going to react to this level. And it's done that oscillation here because, as I said, like the market doesn't just go down and keep breaking through it. It's oscillating right now in the 200. And the only way up would be, or the only way out would be either touching the 20 and then like going down, or maybe just kind of like moving up again from there, and the market says, okay, I'm done with it. So we don't really know, but our goal is to follow the trend, follow the market, and decide on what is the market have in store for us, find good levels to buy it on, good levels to sell it on, and keep the 200, the 50, the 20, buy close to that, and that's going to be a savior. So for this level 2, you could either buy it or let it touch to the 20. That could be one strategy if you want to buy at this point of time. But if you're looking to sell, maybe wait for it to find a level that it's trying to turn its wheels on, and then like decide, okay, what to do next. So I hope this was helpful. I know it's an extremely long video. If you've managed to stay till the end, I congratulate you, commend you for this amazing perseverance to actually like go through this entire video, because it's not easy. A lot of you may just be like, oh, I'm just so exhausted, this is too much for me. So I really celebrate you for going through me with this journey, and I'm not going to just stop here. I'm going to look at other stocks, other oil is another one that I want to look at, commodities, because by just studying this, it gives you such a better perspective of what the journey of the market looks like. What is its trials and tribulations? Where did it recover? What's the rock bottom for the market? And it'll help you become a better trader, so that when you see something happen like this in the future, you know exactly how and when to react to it. So I hope this was helpful, and you do stay with me for this journey as we become better traders and as we learn. And give me comments in your comments of what you feel is something that we could something on the charts that you've identified as well, and help the community grow as well as we grow along with it as well. So I hope this was helpful. Do stay tuned for another video, and I'll see you very soon. Thank you so much.